Good morning, everyone. It's 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman, and here are the three things that you need to know to start off your morning. The specter of inflation weighs on sentiment this morning, mainly in the shape of elevated yields and oil prices. Investors also keeping an eye on a strong dollar and the impact that it'll have both home and abroad. Global data isn't painting a rosy picture outside of the U.S. either. Factory orders in Europe's biggest economy plummeted in July, and another rate hike is still on the table. The painful run for home buyers continues. Mortgage applications slumped to the lowest level since December 1996 as higher rates continue to weigh on demand. Data from the Mortgage Brokers Association shows total application volume falling 2.9% on the week. The average interest on a 30-year fixed-rate mortgage stands at around 7.2%. And the waiting is the hardest part. Amazon could be hit by an FTC antitrust lawsuit later this month, with the action expected to target its most popular marketplace. Now, the Wall Street Journal report says that the online retail giant hasn't offered concessions in what looks like they could be the last discussions before a filing.
Well, global economic growth prospects are confronting a unique mix of headwinds, from interest rate increases in hopes of containing inflation to lingering pandemic effects on China's recovery. But what could a slowdown mean for some asset classes? We are zeroing in on a couple of them this morning, in particular the U.S. dollar. The strength behind that currency raising concerns for investors and sending Asian currencies to monthly lows. But the dollar continues to rise on signs that the U.S. economy is improving here. Brian Sazzi spoke to Jan Hatzius, Goldman Sachs chief economist, on why he believes we'll most likely avoid a recession.
I think there's increased evidence that we can see rebalancing of the economy, inflation coming under control, and it's not going to require a recession. So we've progressively reduced our recession probability. We had it in the 30%, 35% range around March, when you had the financial turbulence and the banking turbulence. Always thought that it was less likely than 50%, but I've gotten incrementally more confident that recession can be avoided.
Well, apparently he's not the only one, right?
Yeah.
Because we have seen that sentiment really shift this year towards being more optimistic on the economy. And that is definitely one of the things that has helped support that strength in the U.S. dollar.
Yeah, and one of the interesting things in the correlation between inflation, of course, and relation to a recession, but inflation also to the decline in the dollar. There was the thinking earlier this year that U.S. inflation, if it continued to at least abate here a little bit or, decelerate, that it would further a decline in the dollar. We're continuing to watch more economic data that comes out that shows that inflation, even if we are continuing to see some type of cool, that the dollar for right now, in the rise that we've seen most recently, the larger question being where other assets and where perhaps in the riskier realm of some of those assets would there stand to be some type of benefit? And that was what many investors over the course of early this summer were paying close attention to, a rise in some of the propensity for those risk assets, given the weakness that we had seen in some of the dollar. But as of right now, I think for where we've seen the inflation picture continue to kind of show itself, at least in moving back towards a decelerationary phase here. I think for a lot of consumers out there, they're looking across what that means for a recession and just trying to figure out, okay, if this means soft landing, can I be confident in how much I'm going to spend, or what some of the larger purchases that I can feel more confident in spending on right now is? Well, it's not a house, and it might not be a car as well here.
Right.
But that all in relation to how strong or weak the dollar has been moving even over the past 2 months.
Yeah, so the dollar, I mean, forget about consumers for a minute.
Sure.
The dollar has important implications as well for other countries and for companies. If I'm a company and the dollar is strengthening, that means that there are implications for me bringing my overseas revenue back to the U.S., right? And the value of that not being as strong if the dollar is stronger than those local currencies. And there are also implications for other nations, because if the dollar is strengthening, conversely, their currencies are weakening. Japan in particular seems alarmed about that. An top currency official there saying that Japan is ready to take action amid some of the speculative moves that we've seen in the market. The PBOC in China as well, the central bank, they're also talking about that issue and issuing some stronger guidance for its reference rate for the yuan. So a lot of different implications here when it comes to what's going on with the currencies globally.
Yeah, and another asset that we are watching this morning is oil. We're watching this closely as a clear driver for inflation globally. Oil jumped to 10-month highs on Tuesday after Russia and Saudi Arabia announced supply reductions intended to keep crude prices high. One of the huge kind of parts of this as well, the price of Russia's flagship, we've been watching that here, and that has continued to be above some of the G7 price caps. That particularly has been of note, especially as Russia is continuing to kind of move forward and monitor, or say at least that they're looking to stabilize prices. But price stabilization for them is something that's a little bit more detrimental for the rest of the world.
Yeah, the dynamics in the oil market recently have been really interesting. We were just talking about the strength in the dollar, which traditionally has not meant strength for commodities and oil prices in particular. But the oil has been strengthening lately, and WTI in particular is up more than 20% this quarter thus far, on track for its best performance since the first quarter of 2022. So we've seen that strength, now a little bit of a pullback. There are some potential indications that oil is getting a little stretched or a little overbought if you look at momentum indicators. Brent that we just saw, so we were showing Brent and WTI, Brent below $90 for the first time since last November. So after this climb that we have seen, a little bit of a pullback occurring today, even as some of the analysts who watch oil that we've talked to say they don't expect oil necessarily to fall much further, even with some of the global growth concerns surrounding China.
Yeah, and for China, the oil demand has not been or held up as strongly as many would have anticipated with the growth projections that were set forth at the beginning of this year. So that also having an impact because China not purchasing as much from some of the other counterparts or global, and specifically Russia, purchase agreements that they had set forth or at least discussed last year amid the ongoing invasion of Ukraine, and then this relationship that furthered itself between Russia and China as well. Right.
Well, as we watch all of this geopolitical data, we just heard a moment ago from Jan Hatzius of Goldman Sachs. We're going to have much more from Goldman Sachs' Communicopia Tech Conference. That's where that interview was from. Our executive editor, Brian Sozzi, spoke with AT&T CEO John Stankey, T-Mobile CEO Mike Sievert, Secretary of Transportation Pete Buttigieg on all things driving the tech industry forward. You certainly won't want to miss. We are going to bring you those interviews and more, for that matter.
That's right. Also, the market is pricing in a near certain pause at the Fed's upcoming September meeting. But as policymakers grapple with stubbornly sticky inflation and a robust job market, the Fed's next steps beyond this month are far less certain. And where's that recession that we've heard so much about? Well, with so many unknowns, the safest investments may lie outside of equities. So what should folks keep in mind as they look for more secure shores? With us now to discuss, we've got Sonali Apir, who is the PIMCO Managing Director and Portfolio Manager, and Chris Rupke, who is the Forward Bonds Chief Economist. Great to have both of you here with us this morning. Sonali, I want to begin with you there, perhaps. Where is this recession that we've been talking about for the better part of a year, and is it off the table?
You know, data has come in better than expected so far, and inflation has come down, and unemployment has been relatively low, and so that's really helps the outlook for the broader U.S. economy and kind of delayed that potential even for a recession. And really, I would say at this point, many are discussing, that it may not be in 2023. That said, we do have some growth headwinds that we're monitoring for the second half of 2023, such as with the loan prepayments starting, student loan prepayments starting, tightening credit conditions and monetary conditions, as well as a decline in consumer savings. That said, I will highlight that, to date, we have seen a relatively resilient economy, and it could just lead to some stagnant growth and not necessarily a recession.
Interesting there. Chris, what do you think is the biggest risk to this sort of growth optimism, or at least not recession optimism, that has come back into market perception here?
Well, I'm a little bit worried that geopolitics, or at least politics down in Washington, are going to come back and bite us on the behind before we get through the end of the year. Let's not forget, I don't think a federal government shutdown is off the table at the moment, and there could be some adverse headlines about that coming forward. Other than that, a recession, economists' track record at forecasting a recession are pretty dismal, to say the least. The problem with a recession is that all of a sudden the economy just goes vertical. Everything looks like it might be a recession, but all of a sudden these things, it just falls away. And there's no indication at the moment, trying to peer around the corner, that we're going to see massive job losses that would mean the economy was falling away quickly.
Well, Chris, that's been one area that we haven't seen too much of a turnover, although we did see a slight move higher in the unemployment rate in this most recent monthly jobs report. A lot of economists are saying that that needs to get to upwards of 5% in order for us to really say or kind of signal that a recession is either something that we're in the midst of or something that is impending. And so with that in mind, where has the Fed, where are they continuing to kind of monitor for cracks in the labor market right now?
Well, I mean, sitting around on a trading desk decades ago, we didn't have much to do as a trading floor economist. And one of the things we noticed that for a recession to be a recession is the unemployment rate has to rise 0.5 percentage point from the low. And that pretty much almost every time except one since the 70s meant we were in a recession. Job losses define a recession. So I know I said we can't see a recession coming at the moment, but that's a little ironic after the unemployment rate lifted from 3.5 to 3.8. Anyway, at the moment, the low for unemployment was 3.4. Now we're at 3.8. We're at 0.4 percentage point. We're really only a tenth away from indicating a recession, but there's reasons to believe that 3.8 last month won't stick.
And Sonali, there's what we sort of think and say about whether a recession is coming, and there's what people are actually doing with their money. You told us that you're seeing clients de-risk to some extent. Why are they doing that, and what does that look like?
You know, equities have performed very well year to date, and when you look at the starting level of yields and the income that it produces in fixed income, you know, when looking at that asset class versus equities, you know, we're at a point where we haven't seen this relative value in some time, and bonds are looking very attractive given where the 10-year rate is, for example, in treasuries, but then also even adding on some credit spread to enhance yield. You know, this level of income is quite, can lead to long-term equity-like returns through fixed income investing.
Okay, and so with that in mind, are there other areas where investors should be keeping an eye on for, or perhaps rotating out of with some of the risks that are present right now, Sonali?
Yeah, you know, I think there's still uncertainty out there, even if, recession timing and probabilities have either declined or extended. The reality is that within fixed income, there's a lot of opportunity to have high single-digit returns, and doing so, for example, in agency mortgages. This is an area which is highly liquid and is providing opportunities that we haven't seen in quite some time as a result of the Fed no longer being a key investor there in terms of, especially, we find more attractive the high coupons that are versus the low coupons that the Fed was in. Other areas include, some for high quality returns in investment grade where default is quite remote. Even some high quality parts of high yield look still attractive when you think about, call it the yield that we have today, and reasonable technicals as at least at the moment, and fundamentals where, while we have seen some deterioration, they've started from pretty robust levels.
Chris, I want to circle back to something that you said at the beginning about keeping an eye on Washington. I know you're not a political scientist, you're an economist, but we have to figure out if there's going to be a government shutdown, what effect that could have on the economy. How are you sort of modeling that at this point?
Not really trying to model it here. It's something that could just come out of nowhere. All the talk sounds like the Republicans, many Republicans, a handful of Republicans aren't happy with the agreement they already got. almost every year that I've been an economist for decades now, the Republican Party thinks we have a spending crisis. So I'm very afraid that they might take more dramatic moves to try and bring down the deficit, which of course is a risk for like 10-year Treasury bonds. There's a reason 10-year Treasury bonds are above 4% now, and I think that's the supply deluge that's still coming. The U.S. Treasury borrowed 1.5 trillion each of the last 2 years. This calendar year, they're saying it's going to be 3 trillion. I'm sorry, 1.5 trillion, and now 3 trillion. 3 trillion is a big number, and I'm still. Well, if the Fed's going to keep rates higher for longer, maybe that's not the only thing that's going to keep rates higher for longer, because the Treasury has a massive borrowing requirement.
Yeah, this is a great point, Sonali. Because of that and that supply coming to market, how high do you think yields, say, on the 10-year could go?
I think yields at this stage are a reflection of significant, the Fed has hiked rates quite significantly over a short period of time. That said, I think we are towards the higher end of a range for where the 10-year could be, call it through year end. But the reality is there's a lot of uncertainty out there, as we mentioned, in terms of second half growth headwinds, in terms of potential for government shutdown being, while we do think it will be resolved, it's a time frame question and expectations. And of course, as Chris has mentioned, also geopolitical risk. So, do I think that fixed income is attractive at these starting yields? Yes, but it could mean some volatility along the way.
Thanks to you both so much. Sonali Peer, PIMCO Managing Director and Portfolio Manager, and Chris Frupke, Forward Bonds Chief Economist. Have a great day to you both.
Thank you.
Well, Amazon could be hit by an FTC antitrust lawsuit later this month, with the action expected to target its popular marketplace. The Wall Street Journal reported that the online retail giant has not offered concessions in what could be the last discussions before a filing. But if it happens, is a breakup necessarily a bad thing? Joining us now, Tom Forte, D.A. Davidson Managing Director and Senior Research Analyst. He sees the potential for Amazon to overcome the risk like Luke Skywalker, who escaped from the trash compactor in the original Star Wars. Please, Tom, elaborate for us. And it's great to see you, by the way. So a last-minute escape from the trash monster, I suppose. I don't know what the FTC. I don't know what that says about the FTC in this analogy.
All right. So what it says is this: we just published our 26th white paper on the convergence of the technology and retail sectors. And this was third in a series of factors that could slow the share price of Amazon. So death of Amazon 3.0. Now, Julie and Brad, when I started the research in April, I didn't intend, or the outcome was different than my initial expectation. And the way that I think about it is antitrust regulatory risk is significant for the stock, but I do think there's a way the stock can continue to perform well. The reason I believe that is governments across the globe understand Amazon, Apple, Facebook, Google. They have too much influence on consumers' lives. They're considering new legislation, enacting new legislation, fining them, trying to block deals. I think Activision and Microsoft. And now they're suing them. But if you look at Meta Platforms and Alphabet, Alphabet's meaningfully outperformed since its antitrust lawsuit. And Meta Platforms is essentially in line. And then call it a worst case scenario where the government succeeds in breaking apart Amazon into what we think would be three natural parts: a first party retailer, Amazon sells products to the consumer; a marketplace, other companies sell products to the consumer on Amazon's platform; and a cloud computing business. And if you look at the sum of those parts, it's higher than where the stock's trading today. So I think there's an opportunity, like Luke Skywalker in the original Star Wars, for Amazon to escape from the antitrust scrutiny and for it to actually work for the stock.
Does that then create a vacuum of interest, at least from investors, in the other two parts of Amazon, given where the majority of those margins and profits are coming in from?
So what it does, or what it should do, is it should ease investors' concerns on these very alarming headlines that they're about to get sued for antitrust by the FTC. So The other thing that's important here is if you look at IBM and you look at AT&T, there was about a 10-year period of distraction where they managed through their own antitrust lawsuits. The good news for Amazon, if you go back in time, it's essentially in their DNA to manage the business with intense government scrutiny. Think about what they did when it came to online sales tax for more than a decade. And that was ultimately determined by the Supreme Court decision in 2018. So I think Amazon has the ability to deal with what could be a 10-year period of distraction from this antitrust lawsuit by the FTC. So less risk for Amazon shareholders than we initially expected when we started conducting the research in April, and the potential for a positive outcome if the company's broken into pieces, given our view that the sum of parts is worth more than the whole right now.
And so it sounds like you would recommend, I know you have a buy recommendation on the shares, Tom. What's the most valuable part of Amazon?
Well, I think the most valuable part is the cloud computing business, given that when you compare it with Amazon as a marketplace and Amazon as an e-commerce company, it has very attractive margins, and it still has a relatively elevated growth rate. So one of the other things we wrote about in our white paper is the challenge for Amazon stock is that its two most important businesses, cloud computing and e-commerce, are showing signs of maturation. So at some point in time, they're going to need new initiatives. We've talked a lot about what they're doing in healthcare, what they're doing in advertising, what they're doing in video. Those initiatives are going to have to meaningfully contribute to revenue, or we could see an air pocket, meaning a period of slower revenue growth while we wait for those new initiatives to kick in.
When you look back on some of the other companies that you mentioned that have had long periods of distraction, what is that risk to Amazon shares right now, even amidst that longer or drawn out period of distraction with this case from the FTC? And what type of movement to the downside, even in the interim, given the price target that you have on it, you believe it's still going to do well, but in this interim period, there could be a lot of volatility.
Yeah, so were Amazon to reconsider raising their fees to people using Fulfillment by Amazon in fear of a government action, that could slow revenue growth and slow profitability growth, which would have a negative impact on the stock. That's kind of one great example. I think you're seeing, though, signs of Amazon making adjustments. 60% of units sold on Amazon were by third parties in the second quarter. That's an all-time high, and that continues to accelerate. Additionally, you're seeing them scale back their private label efforts. So I think Amazon, as part of Andy Jassy's strategy of making it more of a services company, is doing things that I think the government would like, meaning increasing the mix of third-party sales on the platform, de-emphasizing the first-party revenue, meaning when consumers buy products sold by Amazon on Amazon versus a product sold by someone else. And then the company's choosing to do that on its own because it believes that that'll result in higher margins as part of Andy Jassy's vision of Amazon as a services company.
Tom, always good to speak with you, get some of your insights and analysis on this. Tom Forte, who is the D.A. Davidson Managing Director and Senior Research Analyst. Tom, great to see you.
Thank you.
Thanks. All your markets action straight ahead, everyone. Stay tuned. You're watching Yahoo Finance. Coming up, you know Yahoo Finance will travel far and wide to bring you the story. So we sent our most intrepid reporter to one of the world's most innovative cities, a man who needs no introduction. Okay, Stan Howley. Find out what he's up to on Yahoo Finance's Next.
Let's get a check on some movers that we were watching. Roku among them. The shares are soaring almost 10% after the company announced it's going to be cutting 10% of its staff, or about 300 workers. Those layoffs, the third round of job cuts the media company has undergone in less than a year. The company is also going to be consolidating office space. It is going to review its content portfolio, all in an effort to further trim costs.
Yeah, they said as a part of this, they expect to record a restructuring charge, that pretty typical, related to the workforce reduction consisting of severance, benefits costs as well. This was put forward in a filing earlier today, and the cost of that is estimated to be in this range of $45 million to $65 million here for the company in Roku. And they expect that the majority of this is going to be incurred actually in the third quarter of fiscal 2023. So that's when you can really expect this to show up in some of the company's quarterly financial statements as well.
It's interesting, excluding the charges related to this, it says it's actually going to make more than it expected in revenue, that is, for the third quarter. Revenue now, it's targeting $835 million to $875 million. It had been $815 million. So doing this cutting even as the revenue seems to be improving here.
Yeah, it's interesting. We were taking a look at that year-to-date chart a moment ago, still holding on to gains of above 100% over the course of this year. So at least for the company that's been able to kind of look across its offerings, make sure that as a hub on so many devices, television devices, or even building out its own content offering as well, and making some strategic acquisitions years back in that effort, and now looking across where they can further their own relationship directly with the consumers instead of having to just be that hub where other major streamers, whether it be Netflix or Hulu, have that relationship with their end users as well. I think Roku has been able to do well, at least according to some investors, over the course of this year.
The stock has doubled this year, as you pointed out, but it was down 82% last year.
And a little rebound.
And it was trading above $300 in 2020. So just to give some perspective on the rebound it's seen, but after, coming down to some lower levels than it was historically. So in terms of what we're watching in today's session is we've got a little bit of pressure on the futures. We talked about earlier that attention is a little bit on other asset classes, with investors watching the effect of the stronger dollar and now a little bit of weakening oil prices and what effect that is going to have as it trickles through to U.S. companies. As you were talking about yesterday, we're still getting some earnings that are trickling in. We're also going to be getting some economic data in the 10 a.m. hour that we will be keeping an eye out for.
Yeah, some good household company names, whether it's Express, we'll talk about them later. Kroger, we got them this week. GameStop this week too.
Yeah, some things going on.
There's a few ones, yeah.
All right, well, there we had the opening bell on Wall Street. So let's indeed do a quick check on the markets, sponsored by Tasty Trade. As we just talked about, futures indicated a lower open, and it looks like a lower open is what we have. The Dow off by about 91 points. That's about 0.25%. The S&P and the Nasdaq also off by 0.25% today. So sort of a muddling along. This is not entirely unusual for what we see at the beginning of September. We talk about the volume coming back. We talk about people coming back to work and to school, but there is, in this first part of the month, kind of an absence of catalysts, right? Big catalysts. Yes, we have, Brad, those individual companies, but there's not sort of the big suspense until the end of the month when we have the next Fed meeting, for example, and more economic data as it starts to ramp up next week with inflation data. So ahead of that, people sort of settling back in is how it feels.
Yeah, it's not like we're going to see...
Maybe I'm just projecting.
No, I think you're right. We're not going to see any major absolute value move based off of Restoration Hardware's earnings this week. Right. So in the absence of any of those kind of major catalysts, let's take a look at the major averages here. Flat, just barely to the downside. Well, fractionally lower for the Dow Jones Industrial Average, down by about 0.25%. Nasdaq Composite, that's down by about 0.3%, and about the same basis for the S&P 500 as well over the course of today. Still holding on to solid gains for the S&P 500 year to date. That's up a little more than 16%. Let's take a look at the 11 sectors for the S&P 500 as well this morning. You're going to find those once we have them calibrated here on our screen, lower across the board. As of right now, XLY, consumer discretionary, pulling up the caboose. That's down by about 0.5%. I had to double check, make sure I had this set on intraday. I indeed do, so we are good to go there. And fully looking at the right picture out of the gate this morning, all 11 S&P 500 sectors are lower. Energy even, that's down, flat flat, barely to the downside. Let's take a look at some of those tech-heavy names, or the tech-heavy average at least. The Nasdaq, you're seeing a lot of red here on the screen. Pretty much all of the mega cap tech stocks that we were looking at in that corner. I'll go back to that in a hot second. You got Zscaler. Oh my goodness. That's down by about 4.5%. That's pulling up the caboose in the Nasdaq 100. However, you've got some moves in Meta and DocuSign that are ultimately higher here. And then also Dexcom looks like that's having a good start to the day. DXCM. All right. The ticker, or at least the chart won't pull up for me here, but what I can do is actually go back over to our view of these mega cap tech stocks there for you. The Apple, Microsoft, Google, Amazon, you've got all of those in the red as of right now. So we'll continue to keep a close eye on those as we move on throughout the rest of today's session.
Yes, we will. We'll be watching those. And here's another one that we're watching. It is Block, getting hit with the downgrade this morning from UBS, which is cutting the stock to neutral from buy. The stock was actually down quite a bit more in pre-market trading. Now it's only off 0.25%. But UBS analysts citing limited upside potential for the digital payment platform. The analysts there also slashing the price target to $65 from $102. It is interesting that we were seeing it take more of a hit in pre-market trading, and now not as much. Kind of unusual there that we're seeing that, but the UBS folks basically saying that gross profit growth is an area of focus for investors.
Yeah, and relating that gross profit growth, or the slowing within that, to softening consumer discretionary spending as well here. And so that potentially something that could weigh on it. They said a lack of catalysts in sight, reacceleration of gross profit, unlikely. We see limited upside potential, as you mentioned there. This, of course, the parent company of Cash App, perhaps near and dear to a lot of the folks who are watching today's hearts. Hopefully you're getting some of those deposits. And, you know, you might be a good friend and just making sure you're paying people back. That's good too. But shares trading near a 5-year low in terms of their some of their multiples here, largely priced in gross profit slowdown is what they went on to talk about as well. Let's also just quickly hit here airlines. Watching airline stocks today after Southwest, United, and Alaska all raised fuel cost guidance. Now, this is interesting here. They're warning of higher prices to come despite renewed demand for travel. And actually, if you look at all of their individual statements, they kind of say the same thing, but something slightly different here. For United Airlines, at least, jet fuel prices climbing over 20%. As a result, companies all-in fuel price now expected to be between $2.95, as you're seeing there on the screen, to the top side of that range of $3.05 a gallon. But then if you go even further and kind of look at some of the other statements that had come out, I think for many of them, and I took a look at Southwest this morning as well, there's a different type of demand, or at least customer category that you're going after. If you're United versus Southwest, and for even Alaska, all of them coming out with this sweeping move to announce today just goes to show that investors need to continue to keep a close eye on where those fuel costs, which are negotiated usually months in advance, where that's moving for them. All of these airlines getting out in front of that for their investors.
Yeah, and here's another one where the stocks are moving more in pre-market trading or more universally down. In particular, Southwest was taking a hit, perhaps because Southwest is seen as more vulnerable than those other airlines to begin with. Southwest also coming out and saying unit revenue, which is a measure of demand and fares, is going to be down 5 to 7% from a year earlier this quarter. The outlook had been 3 to 7%, so now 5 to 7%. So basically, that outlook getting a little bit worse. But again, it was hitting the shares more earlier, and now they're a little changed. Perhaps investors taking a closer look, deeper dive into the filing as the morning goes on.
Yeah, even with Southwest, they'd have given us a little bit of the inclination into how, of course, the hurricane season is beginning to impact them as well. That was named within this filing. So that perhaps an early glimpse of where Southwest might have a little bit more to say when they finally do report the full financial report or performance for the quarter. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
It's not enough to know what's happening now. You need to know what's happening next.
I'm Dan Howley, and this is What's Next with Samsung.
People put it in the water.
That's pretty gnarly.
Water.
The
This is the heart and soul of astrobotic. This is where we build our landers up to go to the surface of the moon.
Is the future high power, bigger boats? How easy is it to take the battery out, do the charging thing?
Imagine being able to charge without ever plugging in. It's becoming a reality thanks to technology that's hidden beneath my feet. We'll show you what tomorrow will look like today. Join us for our new series next.
Welcome back to Yahoo Finance Live. We're still at the Goldman Sachs Tech and Media Conference, Day 2. And joining me now is Eric Sheridan, Managing Director at Goldman Sachs. Eric, thank you for having to the conference. Again, really enjoy being here. And you cover a lot of the companies that the Yahoo Finance community follows religiously and they love. But before I get into some of these tickers, what is the appetite to own some of these big cap tech stocks, given the runs they have seen this year, and in many respects, they're trading on peak multiples?
Yeah, I think it depends on the name, but generally I think there is a view that owning large-scaled technology companies that produce compounded returns is an area of focus in the market right now. So of all the companies I cover, I would say investors are playing offense on all of those names. But among the larger names, especially the ones that can be valued on GAAP earnings, you know, the Metas of the world, the Alphabets of the world, there is an increased focus of being able to buy compounders at reasonable valuations against earnings power. And then you have the emerging players like Amazon and Uber that are large-scale players, but are still in the process of growing into their GAAP earnings. And that's attracting a certain type of investor that's interested in growth growth at sort of a rising profitability narrative. And I think those are the two interplays we get in terms of talking to investors.
When you talk to investors, are they worried about what the Federal Reserve does? Because the thinking is higher rates, bad for tech stocks. And if the Fed is out there next year raising rates, tech stocks, maybe they don't do well.
Well, I think we went through a process of investors absorbing higher rates for longer at the end of last year and the first half of this year, and you saw a very aggressive reset of valuations in technology in the second half of 2022. We think that reset has mostly happened at this point, unless there is a change that 5% rates plus or minus are going to be the new normal. If we end up with higher rates than that, we'll have to go through another valuation reset probably for the broader group. But our house view, and Jan Hatzius, our chief economist, was here yesterday from Goldman Sachs, would be that the recession probability is coming down and the Fed is unlikely to raise rates anytime soon in the next couple of meetings. So that's our Goldman Sachs house view as published by Jan.
All right, let's go into some of your companies that you cover. Let's start on Amazon, because folks on our platform are waking to news that maybe Amazon is broken up. There's a lot of concerns about what the FTC does to Amazon or doesn't do. Do you think Amazon gets broken up, and what does it mean to that stock?
We still put a low probability on that. We do use a bit of a sum of the parts valuation in terms of looking at Amazon, because Amazon is in very different businesses. Historically, we have written that we don't see any antitrust concerns between the consumer business and the cloud computing business. Without knowing what the FTC is going to allege, the press is reporting that some of it is around behavior inside their e-commerce business, the way they use the Prime subscription to incent behavior on the consumer side, and the way in which their third-party seller business interacts with their first-party seller business. Without knowing the details, it's tough to know exactly what they're going to allege. But those are some of the examples of areas we think they're going to examine and continue to examine from an antitrust standpoint. We do highlight, though, that Amazon still is a relatively small percentage of overall retail sales in the United States, and still a much lower percentage than that outside of the United States. So still a long way to go on e-commerce penetration.
Does this issue, though, hang over that Amazon multiple like a black cloud?
Look, anytime something regulatory comes into the headline, it's going to be an overhang. I will tell you, until this lawsuit probably gets filed, the next 3 weeks will be investors asking me, what do you think is going to be in it? What do you think the potential outcomes are?
I'm warming you up here for those questions, Eric.
Exactly. Okay. And unfortunately, folks like myself won't know until we see it. So that, in effect, I agree with your hypothesis, that will act as an overhang over the next couple of weeks, probably.
Fair enough. Another name you cover, buy rated on Meta. It has been a big year for this company. The stock has gone through the roof. You have had Meta really drill down on costs. The street likes it. The top line has started to improve. What does next year hold for this stock and also a company like Meta?
Yeah, so they're still in the process of going from some of the consumption shifts we saw towards short form video, messaging, and other platforms now to being monetized. So you're seeing that reacceleration of revenue at Meta. We think you're going to continue to see revenue reacceleration all the way through the end of this year into the beginning part of next year. That's the first catalyst on Meta. Second is, while this is the year of efficiency on costs, as talked about by the CFO, Susan Lee, and by Mark Zuckerberg, you're still going to see the benefits of incremental operating margins next year, not just this year. So we would tell you you're still going to see earnings momentum. The third is going to be an interesting catalyst. At the end of this month, they're holding their Connect event, and we expect Meta to put on display a couple things. The output of some of their AI efforts and how they might be consumer and user facing going forward, and some of the metaverse initiatives that have been a big drag on profitability and a lot of the losses as they break that segment out. But now you're going to see some of the products, which sets up for an interesting dynamic next year for technology. You're going to continue to see Meta putting out virtual and augmented reality products under the Quest brand, and you're going to see Apple launching their Vision Pro product early next year as well, which sets up as an interesting product dynamic for technology into 2024.
Some would say Meta's revival this year has come in part because of what's happening over Twitter/X or X/Twitter, whatever it is. Is Twitter just a non-factor at this point in social media? And then do you crunch the numbers on what a company like that is worth? Do you even go through that exercise anymore?
We typically don't value private companies. We haven't valued or talked about that for Twitter since it was acquired by Elon Musk. Twitter, though we have written in a number of our research reports as we've done work on the advertising sector, quarter in and quarter out. Twitter has been a share donee of ad dollars. We've written about their ad revenue, even though they're a private company, being down 50 to 60% year on year. That's about $2 to $2.5 billion of dollars donated back into the broader advertising landscape. But that in and of itself is not why Meta is reaccelerating. It's really elements about unlocking revenue potential in short form video and on messaging via Facebook Messenger and WhatsApp.
30 seconds left. Your biggest stock call for the next 12 months.
Amazon is the number one pick, followed by Uber. We see rising utility, rising profitability, and as they grow into GAAP profitability, we see a lot of interest in those shares going forward.
Good calls indeed. Thank you for having us to the conference again. Really enjoyed being here. Eric Sheridan, Managing Director at Goldman Sachs. I know you have a busy day on tap. Thank you so much.
Thank you.
All right, do tune in, I should say. Much more ahead from the Goldman Sachs Tech Conference here in San Francisco on Yahoo Finance Live all day. We'll be right back.
Coming up, there's Yahoo Finance's tech editor, slack-jawed and spinning like a pinwheel. Does Dan Halley make it home, though? That's the big question. And does he even make it out of the town square? Find out. Yahoo Finance is next.
The U.S. dollar index is heading for its 8th straight week of strengthening. It's the longest such run since 2014. And here with how the expensive dollar weighs on stocks, Yahoo Finance's Jared Blickery joining us from the NYSE. Jared, talk us through it.
Thank you, Julie. Let's go to the Wi-Fi Interactive because a chart is worth 1,000 words in this instance. Here is the Dixie, the DXY. This is a max chart. I'm going to dial this down to a year-to-date. You're going to see down here the U.S. dollar index bottomed in early July, and as you said, Julie, it is on an 8-week run here. Pretty big move on this chart right here, but take a look at what's happening on a 1-year chart, much less a 5-year chart. You're going to see this move virtually disappear on the right-hand side of your screen, and that's because it's really that small compared to historic moves. Now, the big move was in 2022. That was last year when the Federal Reserve was rapidly raising rates, and there was enhanced demand for the U.S. bonds at elevated yields, and that has to do with that dynamic. So interest rate differentials will drive currencies, as will haven flows. We also had a number of scary events last year, the Russia invasion of Ukraine, and that was a geopolitical event. That automatically sees a flight into dollars. Now let me show you on our dollar heat map versus all the other currencies. This is a year-to-date look, and you can see we have ARS, that's the Argentine peso. US dollar is up 98%. That means the ARS has lost half of its value over the last however many months we have in this year. Then we had the Turkish lira, 43%, the ruble, the South African rand, and it goes on. But then we hit the Japanese yen, and this is a little bit of a scarier picture here. The Japanese yen has weakened to unsustainable levels. Here you can see the US dollar is up 12.5% year to date. Julie, you were commenting on this earlier today. The folks over at the Bank of Japan may have their backs against the wall. So if I'm looking for potential disruptions in currency land, which could leak over into stocks and bonds, that's where I would look front and center. But let's stick with the US dollar here. I'm going to show our China exposed US stocks. This is year to date. Let me show you the last 2 months because that is when the US dollar has had its big run up here. You can see some negative returns here for Apple, for Texas Instruments, for Nike, which derives a lot of its revenue from China. Why China? It's just kind of an interesting cross-section of an emerging market, something that's a market that's very sensitive to the US dollar, and where a lot of US multinationals have a lot of investment and where they derive a lot of their revenue. So the higher dollar, generally not good for US multinationals, but also any company that derives their price from a lower commodity prices. So that even affects small caps at the long end of the range. So going forward, US dollar, if it were to race higher, probably an impediment, but if we're just zigzagging around it within current ranges, probably not the obstacle that some would make it seem.
All right, Yahoo Finance's own Jared Blickery there on the floor of the New York Stock Exchange. Thanks so much for that update, Jared. Appreciate it. Gas prices are slowly creeping higher, I should say, now sitting at $3.80 a gallon here in the U.S. And with a new Wall Street Journal poll showing just 37% approve of President Biden's handling of the economy, could this spell trouble for his upcoming re-election campaign? Yahoo Finance's Rick Newman joins us with the details. Hey, Rick.
Hey, guys. I think President Biden has to be pretty worried about gasoline prices. One reason is that we are seeing oil prices go higher. And they seem likely to go higher still for reasons that President Biden can't really control. Saudi Arabia has done a big production cut. Russia also has cut production. And both of those countries have said they're going to continue those production cuts through the end of the year, suggesting perhaps they could continue them into 2024. So we're now seeing oil around $85 a barrel. And I'm seeing some projections saying it could go to the mid-90s and even up to $100 per barrel. And that's just because of the global market dynamics for oil. The last time we had oil at $100 per barrel, U.S. gasoline prices were around $4.40. And I think for President Biden, any gasoline price that starts with a 4 is just bad news because that, as we all know, gas prices punch above their weight in terms of consumer psyches. And when you start to see gasoline prices to start with a 4, that just signals that something is wrong and it bums people out. So this is something I think the White House is paying extremely close attention to. And there's not a lot that Biden will be able to do if gas prices get out of control again in 2024, when we're really in the thick of the next presidential election.
Rick, I was just down on the West Coast. Forget about a 4. It's 5 out there. That was, they do things differently out there for a variety of different reasons. But in any case, you talked about his lack of control. He has some control at the margins, right? When you're talking about things like the Strategic Petroleum Reserve, et cetera. Like, are there sort of little things he can do, and how aggressively, the closer to the election that we get, do you think he's going to be?
Well, Biden did tap the U.S. Petroleum Reserve last year. He drew down 180 million barrels. And the U.S. Reserve is now at the lowest level, I think, since 1983. That is supposed to be an emergency reserve, for things like if a hurricane comes through and knocks out refineries or something like that, or if there's some, geopolitical emergency. That is not supposed to be just to lower gas prices and cut consumers a break. So Biden, I guess he could draw that down further, but I think that would generate a lot of criticism that he's sort of abusing the strategic reserve. Another thing that the Biden administration is doing pretty quietly is kind of making some tacit deals with unfriendly nations that happen to be oil suppliers. So Venezuela, for example, last year, the Biden administration changed the sanctions regime on Venezuela a little bit so they can import more oil to the United States. There have also been some kind of behind the scenes negotiations with Iran with regard to their nuclear deal and the sanctions in there. And Iran has actually been producing more oil, putting it into the global market. They're not necessarily selling it to the United States, but any additional oil that goes into the global market will help keep prices down. And then there's also this price cap on Russian oil, and there have been some calls to lower that price cap to further punish Russia for its invasion of Ukraine. And it seems there's no chance that the Biden administration is going to try to lead the big nations known as the G7 to lower that price cap, because that could mean less Russian oil. So there are things you're not seeing that the Biden administration is doing to try to keep oil supply going. And one last thing I'll mention, here in the United States, we're probably going to see a new high, a record high in terms of U.S. oil production. And that's not because of anything the government's doing. That's just private sector producers saying prices are high, so we want to pump more because we're going to make money off of it. But it remains an open question whether all of that will be enough to keep gasoline prices in the comfort zone here.
All right, well, we'll see what happens. Rick, thank you so much. Appreciate it. You can read more on this story on yahoofinance.com. All your markets action coming up. You're watching Yahoo Finance.
Did Dan Howley go all the way to Seoul for some light shopping? He's no doubt a tech aficionado and the citizen of the world. You need to know what he's up to. We'll find out when Yahoo Finance is next. It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We're about 30 minutes into the trading day. Let's take a look at how stocks are moving right now. Stocks are lower today as concerns surrounding inflation linger ahead of the Fed's next meeting. Investors will also be looking out to key data this week, including ISM services data that's coming out this morning and is out. And we're also going to be taking a look at some individual movers.
Yeah, Enbridge shares are lower today after announcing it would buy 3 utilities from Dominion Energy in a $14 billion deal. That's including debt. The deal expected to close at the end of 2024. Enbridge's CEO called it a once-in-a-generation opportunity.
And shares of Express bouncing back today after posting second quarter earnings that were in line with estimates and announced a $65 million term loan to strengthen its liquidity. The retailer reaffirmed its full-year outlook.
Shares of GitLab higher today after the company saw revenue jump 38% in the second quarter year over year. It also saw a surprise profit during the quarter. The software company gave a more upbeat full-year outlook than analysts anticipated, and those shares are rising by 7%. Well, Brad just mentioned ISM data coming out, the Institute for Supply Management's Services Index coming in at 54.5. That is an acceleration from July. This is the August figure, and also better than analysts estimated, which was 52.5. Prices paid, though, accelerating month over month. That's interesting, to 58.9. Employment, the measure of employment accelerating, and new orders accelerating. So all of these showing a pickup in August compared with July.
Yeah, this in addition to the consecutive month move that we've been tracking here, particularly in August, the services PMI registering that 54.5%. That particularly means that the composite index indicated growth in August for the 8th consecutive month here after reading of 49.2 in December. So looking all the way back to December to where this trend had begun. And that December period was actually the first contraction since June of 2020 here. Also worth noting the new orders index that expanded in August for the 8th consecutive month as well.
And it looks like it was pretty broad-based here. 13 industries apparently reported growth in August. So basically what this continues is this string of reports that have come out better than estimated. There was an interesting note in Joe Weisenthal's morning note from Bloomberg where he looked at the City Economic Surprise Index. This is a fun one to watch. It basically tracks the rate at which economic reports are beating expectations to missing expectations. And he showed the gap between the U.S. and Europe. The U.S. has been beating at a much higher rate compared with Europe. And obviously this is a reflection of one of the themes that we've been talking about here for the past couple of days that was also reflected in Goldman Sachs, reducing its probability of a recession. Basically a sunnier economic outlook here in the U.S. Not that things are going to be gangbusters, but that the gap between the outlook at the beginning of the year and now is just kind of incredible.
Some of the quotes that we got from respondents here are really interesting and give a little bit more color and telling here. Restaurant sales and traffic trends remaining positive year over year and compared to pre-pandemic levels. Hiring stable. Quality employees available. New California regulations also kind of taken into account here by some of the respondents in July, including minimum wage hikes and implementation of Prop 12 there that largely targeted towards farm animal health and welfare legislation, resulting in higher pork prices. So that really impacting kind of the accommodation and food services side of the equation. Also, if you want to pull through anything that we've seen through other economic data points, look at construction. Sales on a national level have been strong. Commodity material prices remaining stable. Finding areas for cost reductions and material availability has returned to pre-COVID-19 levels as well. That's cited within this particular ISM report for the month of August as well. Also, we got to talk about IPOs, initial public offerings. They've been making some headlines once again. Since the market saw a steep downturn in companies going public during 2022, the likes of Kava, Oddity Cosmetic, and Kenvue made for strong entrants that sparked investors' interest. Now, some of the most anticipated public debuts of the year are still to come, and that includes the likes of Arm, Instacart, and some might even be holding their breath for SpaceX. But it may not all be positive, with analysts arguing that the reason for increased interest is because there haven't been that many companies going public in the first place. And our next guest certainly agrees, saying that 2023 has been the worst year for IPOs since 2009. Let's bring in Equity Zen head of market insight, Brianne Lynch, to discuss more. Where were you when, especially if you think back to 2009? We won't go there. But what we will think about is this current environment that we're in right now. Is ARM really the catalyst to open up the opportunity for the rest of those players that we just rattled off a moment ago?
Yeah, thanks for having me. I think ARM is one where it might not be the catalyst, but it is a company that people are going to be watching very closely. It will be the largest IPO in the US since Rivian in 2021, and it will be a good barometer for investor interest in tech and in AI specifically. Even though they're not an AI company, their real growth opportunity in the future is built around AI. And investors will really be voting whether or not they believe that that's a big enough growth opportunity for them or not.
Hey, Brianne, it's Julie here. The fact that the priced range for the shares is a bit lower than some prior estimates, what does that tell us about sort of initial demand here?
I would say that this $52 billion valuation that they're looking at right now is still a pretty aggressive valuation. It's valuing the company anywhere between 92 and 100 times price to earnings. And this is much more in line where NVIDIA and some of these companies that have kind of ridden the AI wave are trading versus some of their competitors like Qualcomm that are trading at a 15 times multiple. But really, I think investors and a lot of these corporate investors like Apple, Alphabet, Samsung, they're really betting that if their machine learning chips can become the market leaders for AI, that's where this valuation makes sense, because it certainly doesn't when you look at a company that is kind of flat, if not down on sales, and has seen their net income reduced by half year over year.
Is it as simple as believing, okay, down year in 2022, down year 2023 in the IPO market, 2024 means a huge comeback, or is that not necessarily the case here?
I think it's going to be very company specific, and there's a bit of a playbook that companies will need to align to have a successful IPO. We've seen that with Kava, Oddity, Kenvue, and some of these earlier ones. Investors are looking, it seems, for companies that are growing, at 30% plus rates, but also showing profitability. So the world of growth at all costs is no longer where we live, and companies will need to show profitability. On top of that, they need to have business models that investors can understand, or brand names that investors recognize, like Instacart. So Instacart really is checking a lot of those boxes, and I think every private company that is considering an IPO is going to need to look and see, okay, can I meet this criteria? And if not, do I raise another round in the private markets, or do I wait?
But this is not like an environment where we were looking back at, say, the dot-com bubble, where you had a bunch of companies that were looking to go public that simply, slapped on .com at the end, and they were making market entrances, and many of them kind of fell out as a result of that. This is, for what we've seen in AI, seeming like, even though there's a lot of tangible either models or chip companies or even, just different data sets that are out there, this is not like we'll see in 2024 a bunch of AI companies that'll just make a market foray or equity market debut, and investors just jump to get in early.
I don't think that will be the case because so many of these AI companies are relatively young. They're companies that have been around for 2, 3, 5 years. They're not the unicorns that have been around for 10, 15 years who are feeling both the liquidity need of early employees and shareholders, but also just ready to, put on the big boy pants and enter the public markets, and enter that phase of growth. So I don't think a lot of these AI companies are there yet. And what you're seeing with ARM is a company that's not an AI company. They're a chip company, but there is, a market opportunity for them that comes with AI. So the AI adjacency may help their story, but they're not a pure play AI company.
Brianne, you guys at Equity Zen, you have a private market platform on which things are priced. What kind of demand are you seeing reflected there? I'm very curious in particular about valuations, about private market valuations right now, and what they can sort of imply about public market valuations when those companies eventually come public.
Sure. So we have a really good lens into, where investor demand is in the private markets, given our marketplace. And we've seen a bit of a correction over time. So, 2021, height of the market, companies were trading at pretty aggressive valuations in the private markets. We saw those valuations come down by around 50% as investors were just not willing to pay these aggressive prices for companies anymore. Over the past month or so, we've seen that discount lessen. So now the average company on our platform is trading at about a 35% discount. So still not at those 2021-ish levels, but recovering a bit. And I think a lot of these companies that are considering an IPO will have either had to grow significantly to have grown into that valuation that they maybe garnered in the past, or accept the fact that they may be going public at a down round valuation versus where they last raised. But I think that's just a fact of where we are in the market. And as more companies do that, it'll become less taboo.
And the other thing I'm curious about, Brianne, I was sort of joking yesterday that we shouldn't call them unicorns anymore because they have become, much more common. It used to be a unicorn was because it was so rare. Now we were saying maybe we call them zebras or giraffes or something that you see more frequently. Are we going to see these huge privately held companies ever come public? I mean, it seems like if the market is not that open, if they're able to raise money privately, why even have an IPO?
I think a big question is, around one, if they're able to raise money privately anymore. A lot of these companies have raised a significant amount of capital from venture capitalists who aren't ready or willing necessarily to pony up additional capital in the private markets. They're looking to return capital to their investors because they've been holding these investments for 10, 15 years. So you can kind of liken it to the parents who are trying to get the kids out of the house. They're 20 years old now, they've graduated, it's time to go. For a lot of these companies, they are feeling pressure from both their investors and their early employees to have a larger scale liquidity event, which can really only happen via an IPO. EquityZen's platform, we enable this for some of these investors while companies are private, but this is on a smaller scale than what an IPO can achieve. And I think that's really the next step that a lot of these companies are going to be pushed towards.
Brianne, just lastly, while we have you, people like space, or at least they're, they fantasize space, or at least think about it or hold it in high regard in one way or another. Should we ever expect SpaceX to go public?
Unfortunately, I can't comment on that, but I know it's one that, people are eagerly watching. And, that amongst many of these other large unicorns, there's a ton of investor demand.
We shall see what the future holds with space. EquityZen Head of Market Insight, Brianne Lynch. Great to catch up with you. Thank you.
Thank you.
We're about 45 minutes into the regular session here, so let's do a check of the market sponsored by Tasty Trade. We have seen stocks take another leg lower here, particularly the Nasdaq, which is now off by about 0.9%. The S&P off more than 0.5%. The Dow not doing quite as badly. It's off by just about 0.25% here. And it's interesting because these losses seem to have accelerated to some extent after we got those numbers on ISM, the services read coming in better than estimated. This is a phenomenon we've been talking about over the past couple of days here. Are we in a situation where good news economically might be worse news for the markets and vice versa? Perhaps that's the extrapolation here. We've got bond yields a little bit higher in today's session. So perhaps that's what's going on. I see you looking over there at the sectors.
You got to these days. I mean, technology right now, it's down by about 1.25%, leading the declines. We had started off the session, by the way, all S&P 500 sectors were in negative territory. We're a little bit more mixed now, about as split as you can get when you've got an odd number of sectors here right now. So just about 5 laggards, 6 gainers at this point.
All right, we'll be back in just a few. You're watching Yahoo Finance.
Now, from the Lower East Side to the heart of Seoul. For some men, I guess all the world is a catwalk. But why is our tech wizard Dan Howley strutting down one of the Korean capital's most famous shopping streets? Well, we're not going to tell you just yet. Find out on Yahoo Finance's next.
Goldman Sachs analysts and top executives from across the technology, media, and telecom landscape are gathered in San Francisco for the company's annual Communicopia and Technology Conference. Yahoo Finance's executive editor Brian Sozzi spoke with Lyft CEO David Risher on what's driving the ride-sharing industry forward. While Lyft and Uber have been considered rivals for many years, Risher considers consumers' obsession with Netflix and, quote, staying at home eating pizza a much bigger threat to Lyft's success. Risher also breaks down the important lessons he learned from his former boss, Jeff Bezos, and why a business is only as strong as its leader.
I am a customer-obsessed person. I've worked at Amazon for many years. I drank all the Amazon Jeff Bezos Kool-Aid about how the best businesses are the ones that fundamentally meet customers' needs and just blow people away. And so for me, I think that the Uber-Lyft dynamic over the last couple of years has been more a competitive dynamic than a customer-focused dynamic. And so what got me really excited about joining up with Lyft is saying, let's really turn this into a customer-focused thing. Let's turn it into being obsessed by our riders, obsessed by our drivers, and you can see the results.
Is the battle about taking it back to Uber, or is it about taking it back internally, getting that vibe back that Lyft was always known for?
Well, I'd say it's about taking it to customers. I really think that. I mean, look, we are social beings. We want to get out of our house. But at the end of the day, we also spend a huge amount of time on our screens. So part of, I mean, it's funny you think of it this way, but part of Lyft's reason for being is we're sort of the interface between your phone and the real world. So that's really what it's all about. And then the excitement internally of trying to build cool products and services for customers, for riders and drivers is fun.
When you're saying that you're focused on the consumer and you want to be consumer obsessed, what does that mean for the Lyft platform? What's not on there that you see could be on there next year?
Well, let me start with kind of the basics, right? Because when we started a couple of 4 months ago, our prices weren't quite in line with where the market needed them to be. So now we've reset our pricing to be competitive with where Uber is. Lower prices than we used to have, for sure. Same with driver pay. We've increased driver pay to be in line with where the market is, and that's really important. Drivers make billions of dollars on our platform, and we need to pay them well. So full stop. So that's where it starts. Then it's about picking you up on time and making sure you've got a good experience every time. And I hope every single day we do that, and I hope we're doing it better every day than we did the day before. And then you start to get into the more differentiated pieces. So let me give you an example. Everyone likes a good deal sometimes, right? We all feel like at some point we want a deal. And so we have an option called Wait and Save, which allows you to basically say, I'm willing to wait another 5 or 10 minutes and I'll get a cheaper price. And something like 30% of our riders every single day take us up on that option. So the reason I point that out is because I think it's a really good option for people who want to save a couple bucks. By the way, I think it's better than Uber's shared ride or pooled ride option, be a little bit competitive on that one. And I think it's an example of how if you really focus on what customers want, you can start to build back to work products or maybe back to school products or all sorts of other things that'll really meet the customers where they are.
Are you priced below Uber? What does your data show?
So our strategy is to really to make price shopping kind of a waste of time, if I can say it that way.
Does it bother you when Uber has these earnings calls and they say they're not thinking about Lyft? Should they be thinking about Lyft?
No, I don't want them to think about Lyft. I want them thinking about their own problems. They got all sorts of stuff. They, their CEO recently said, I wake up every morning thinking how much Uber sucks, and I'm like, that's cool. We agree on that. So anyway, I'm just kidding you. I'm just kidding you. Look, my real focus is I want to focus on our customers. And sometimes what I say is, I don't think our big competition is Uber. I think our competition is staying at home, watching Netflix and eating pizza. I mean, as much as fun as that is, I guarantee it's more fun to go out with a friend.
When I talk to John Zimmer, I've talked to him many times through the years. He pitched his vision to us about Lyft being everything to everybody, shipping this, doing that. Is that your vision?
No. And I think this is an area where John and I would 100% agree. In fact, I know it is. But I think, and I think in retrospect, he might say that a little bit differently. And here's what I mean. The best companies are the ones, as we've said before, that really focus in and say, what can we do for our customers that really is differentiated? And it's hard to differentiate on everything. It really is. And so our focus is on rideshare, providing a great experience every single day. For a time, I think particularly as COVID came, there was a real feeling of like, oh my God, the rideshare business, is going away because of COVID or whatever it is, and so let's try a bunch of other things. But we're coming out of COVID and we're saying, guess what? People still want to go to work, they still want to go to school, they still want to get together with their friends and all the rest, so we're really going to focus on that way.
Your tenure started off, you may have to make some tough decisions, notably on staff, to lay off a good portion of the staff. Are you confident you have gotten to the cost structure that you want to get to?
Yes. Yes. So I appreciate you saying it was hard. It was really hard. Nobody likes it. Of course, employees least of all. Let's be very clear. We had to do it. And the reason we had to do it is because in order to offer good prices, you have to have a cost structure that makes sense. And to your earlier question, if your goal for a while is to sort of try to do everything, you tend to grow your costs. Whereas if your goal is to try to do one thing really well, you have to shrink your costs. So we shrank our costs. That did mean we had to lay off some employees, but we're at a state now where we can innovate on behalf of customers, we can keep the business moving forward, growing financially healthily, and not have to do anything crazy with the costs.
And for those not really familiar with your plant, is the bikes business still part of Lyft? Do you want it to be part of Lyft?
Yeah, so I'm glad you asked about bikes. Let me just, kind of level set for a second. Just in New York City, so Lyft runs bike systems across the United States in a bunch of cities, in Chicago, in New York, in DC, San Francisco, all across the United States. And if you've been on one of those bikes recently, particularly in an e-bike, I hope your experience has been great. I mean, once people start e-bikes, they tend to really fall in love with them. It's a great way to get across the city. In New York alone, we give about 130,000 rides a day. A day. That's as many as in LA, that's as many subway rides as LA does in a day. So I mean, it's a big part of a transportation network now. So for our riders, it's super important. It gets them from point A to point B, often faster than a car, frankly, if it's in New York City. But it's also a capital intensive business for us. And so we're trying to figure out a way to partner with other organizations that specialize in city infrastructure in a way that allows them to take some of the cost of capital, from us effectively, and allow us to just offer it to our riders without it being such an expense for us.
Within the data you are able to receive, what's the health of consumers? Do you see consumers still spending at the clip they were? Are they taking the same amount of rides? What do your users look like?
Yeah, it's so interesting. I know there's a little data out there about some retail softness or and concern about student loans and so forth. We're not seeing any of that. On the driver's side, we see really healthy supply, and on the rider side, summer travel was as strong as it's ever been, stronger actually. Back to work is already feeling like it's off to a really strong start, and same with back to school. So we're not really seeing any softness.
Lastly, before we let you go, not a lot of folks can say they were the 37th employee of Amazon. I mean, that's some OG stuff. What did you learn from those early days, and how are you applying it to Lyft?
The single biggest thing really was that focus on the customer. And it's a bit of a cliche now, in part because Jeff Bezos has sort of made it a cliche. Frankly, I'm trying to take it up to the next level at Lyft. One of the things that I would like 3 years from now, 5 years from now, is that Lyft has redefined what it's like to be a customer-obsessed organization. And one of the things I tell our employees sometimes is, if we're ever so unlucky that you go off and get another job, I hope that other company is just thrilled to get you because they know how customer-obsessed you're going to be. That's really what I learned from Jeff and from Amazon.
A big thanks to our executive editor, Brian Sozzi, and Lyft's chief executive officer for that interview, chief financial officer for that interview. Be sure to tune in to our coverage of Goldman Sachs Communacopia Tech Conference. Brian Sozzi spoke with AT&T CEO John Stankey, T-Mobile CEO Mike Sievert, and Secretary of Transportation Pete Buttigieg on all things driving the tech industry forward. You certainly don't want to miss those interviews. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Seoul has more Starbucks stores than any city in the world, but Dan Halley isn't looking for a brown sugar shaken espresso. Find out why he's there on Yahoo Finances next.
The threat of a potential UAW strike looms large amid ongoing negotiations with the big three automakers. At a rally on Monday, President Shawn Fain of the organization promised that members will take action by any means necessary to secure a fair contract. Those strikes are making headlines across Hollywood and now potentially the auto industry. Union membership has actually steadily declined in recent years to just 10% of the workforce last year. That was an all-time low. But according to data from Cornell School of Industrial and Labor Relations, strike activity actually increased last year. So what can we make of maybe smaller but mightier unions? We're joined now by Nathan Boehme, Axios business reporter, co-author of the Axios Closer newsletter, and David Madlin, Center for American Progress senior fellow and senior advisor at the American Worker Project. Guys, thanks so much for being here. Nathan, I want to start with you. Kind of set the scene for us here as to what we are hearing from the UAW and the sort of effect that could have.
Well, the UAW's newly elected president, Shawn Fain, is a real firebrand, and he has come out swinging. He has basically said that the automakers are giving their executives exorbitant pay and compensation, and that it's time for the workers to get some of that too. With about just a little over a week until the contract deadline expires, it looks like a strike is a real possibility.
Okay, and so with that strike being a possibility, I mean, are we looking at an all-out strike here, or is this, targeting specific plants or specific operations, which then could still more largely impact other areas of the manufacturing process here?
So historically, the UAW will pick one automaker as a target, essentially, to start the negotiations with them. And then if they can't reach a deal, they strike. And then eventually, once they do reach a deal, then they use that as a pattern to negotiate with the other two. But this time, we are hearing there's a possibility of striking all three at the same time. Shawn Fain at the UAW has not ruled that out. If that happens, we would see a serious bottleneck in the auto industry.
So to go from the specific questions here for Nathan to the sort of bigger question for David, I mean, what it feels like here is that we have these very sort of noisy work actions in the form of the UAW and the Hollywood writers and actors strikes. We've had a number of other actions involving the likes of Starbucks over the past couple of years, and yet we do see that union membership declining. So what are we to make of the current role of the union in American workers' lives?
You're hitting, I think, on a core reality that the desire for unions is sort of as high now as it's ever been. About 70% of the public support unions, and about half of the public say they would like to join a union. But as you noted, union membership is sort of near the lowest it's ever been. And that's because, unfortunately, our law makes it very, very hard for workers to join unions and allows companies lots of tools for union busting. And so we're seeing this great upsurge in activity, and whether it can change corporate behavior and change the law, I think, is the real open question.
What is the perception among those represented by the unions as well? I mean, when you think about still the fees that they might have to pay in many of these instances, how has that perhaps moved their own discourse internally or among the workers being represented in one way or the other?
Well, union members generally support their union because it leads to higher wages, better benefits, safer workplaces, and also protections from arbitrary dismissal and discrimination. And so even though some people don't like to pay the fees, because in many states, you need to pay a fee to join, to receive the benefits of collective bargaining. But even in states where you don't, most people covered by a union contract still pay because they see the strong benefits that everyone really receives from union contracts.
Nathan, when we look at the case of the UAW in particular, like many other unions, it has seen membership decline, although it's also because the number of auto workers broadly has declined in the U.S. over the past few decades. But as you've done your reporting, I'm curious if you've gotten sort of a vibe from the union membership itself, not just leadership, about their sort of feelings around the whole situation.
Well, I think there are two aspects of this. First off, 97% of UAW members did vote to authorize a strike. So essentially, basically all of the UAW membership is saying we're okay with a strike if our leadership decides that we need one. However, on the other side, I think it's worth noting that there is a bit of a growing political disconnect between the members and the leadership, because in the last two elections, by the UAW's own admission, about 1/3 of its members voted for Donald Trump. I think this was pretty unsettling for the UAW to realize in 2016 that a lot of its members weren't on the side of its historically progressive politics. And so the question for the UAW leadership is, can they maintain the support of those members when they're at the bargaining table with the automakers?
Right. Okay. So for all of these industries over the course of the year, it's been largely different. And as of right now, it seems like, based on what we've heard from the conference calls, even, or the earnings calls from companies in Ford and GM, they're expecting this to get done. But if it does not, what type of hit to production, but additionally in terms of revenue as well, are we expecting could eventually come forward, Nathan?
We're talking about a risk of potentially billions of dollars here, and that's why the automakers are very, very nervous. I think there's also the possibility of price increases if the contract negotiations end up with a deal that the automakers have to pass on the cost. Just saw an analyst report this morning that said that we could see higher costs of EVs. Maybe that's what's necessary to get the workers the pay that they deserve, but it is important to note what are going to be the consequences. I think that there's a wide agreement here that Tesla would be the winner if there's a big strike, also would be the winner if the automakers have to agree to huge pay increases, because of course Tesla is not unionized. One big question after this is all over is when and will the UAW start to take a crack at organizing Tesla again? They tried in the past, they failed. Will they try again? I think that's a really important thing to watch.
I mean, that brings up an interesting question as well about industries or companies within existing industries that have not traditionally been unionized. And I brought up Starbucks earlier because that is not a workforce that had historically been unionized. And even though some of the stores have been unionized, they haven't really done anything, right? At least that's, in other words, there have not been many fruits of that organizing as of yet. So David, if I'm the union and I'm trying to sell workers on the benefits of being in a union, for those kinds of workplaces and industries, how do I show them that?
Well, you're right that, there have been hundreds of Starbucks stores that have formally joined union. Workers there have joined a union, but they have yet to achieve a collective bargaining agreement. And so the direct gains are harder to show. But I think if you're a union, you point to similar industries, other stores related where you can show the gains. But also, I think you mobilize workers by showing the fundamental unfairness of the boss telling them, no, you don't have the right to join a union, you don't have the ability to bargain collectively. And that's spurs, I think, some of this, rebirth in unionism we're seeing right now is this big disconnect between how workers feel they're treated. During the pandemic, they were called essential. They had to show up to work. They were literally putting their lives on the line. At the same time, companies were receiving near record profits and CEOs doing very, very well. And so I think that frustration is bubbling over, and that's a big mobilizing point for unions right now.
David, do you think we'll see a rebound in union membership?
Well, I think it's the big open question. As I mentioned, there's lots of support for unions, but unfortunately the law makes it very, very hard for workers to form unions and bargain collectively. So I think we need to see both more grassroots momentum, the kind that we're seeing now, as well as policy change in order for unions to regain the strength that the public says they want.
All right, Nathan Beaumont, Axios business reporter and co-author as well of the Axios Closer newsletter, and David Madeline, who is the Center for American Progress and senior fellow and senior advisor at the American Worker Project. Gents, thanks so much for taking the time here today. Appreciate it.
Thanks.
Thanks. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Coming up, there's Yahoo Finance's tech editor, slack-jawed and spinning like a pinwheel. Does Dan Halley make it home, though? That's the big question. And does he even make it out of the town square? Find out. Yahoo Finance is next. Well, it looks like Domino's gets to have its pizza and eat it too. Its stock is outperforming the market despite losses. This comes after Uber Eats and the pizza chain agreed to join forces. Customers will be able to order Domino's from Uber Eats starting this fall in 4 U.S. markets, then available nationwide by the end of 2023. TD Cowen has upgraded the company's rating and is expecting them to outperform. Senior analyst of TD Cowen, Andrew Charles, here to talk more about the business of cheese and pizza. Great to have you here with us today. You've got some fans of the title of your note over here, particularly when you think about the perspective for Domino's. Take us into your thesis and why this for a company that was one of the first movers on kind of like the digital ordering aspect and creating that touch point with consumers and customers. Why this is the next inflection point?
Sure. So good morning. There's been a lack of, frankly, new news, with the company throughout COVID as well as the following period. And, now is the time where we're going to see a lot more self-help initiatives in addition to the Uber partnership that we think is going to lead same-store sales to outperform consensus and really help organically drive EPS beats. And so in addition to Uber, we're really excited about the loyalty program refresh, which is going to make it easier for customers to accrue points as well as redeem points for new rewards. We like the fact that menu innovation, where there's obviously been quite a bit of innovation out there in the sector, more opportunities, for Domino's that I think first will focus on extensions to their sandwiches and pasta platforms. But I'm sure you're like me, where looking for some pizza innovation in the form of stuffed crust, in the form of Detroit-style pizza, in the form of cauliflower crust. Certainly all opportunities for them. And then lastly, at some point in 2024, we're going to see an e-commerce refresh where their app and website is going to get an upgrade, it'll get a facelift, as well as the fact that they've been talking for years about smarter ticket, or the equivalent of what you would see on Amazon, where customers who purchase this also purchase that. I mean, this is a very data savvy company, so they know what people are buying. And so the ability to tie that better to help promote suggestive selling, I think is a key opportunity.
Andrew, where are we in the eat at home to eat out cycle, right? Which obviously we have seen really zigzag post-pandemic. I know you cover a lot of restaurants as well where people also eat out or they pick up, right? So how do you place Domino's within that cycle?
Yeah, so traffic has been broadly a negative throughout the industry. And frankly, it's a reflection of the fact that you're seeing 8% industry pricing. And so certainly there's elasticity here, which makes sense why you're seeing some negative traffic throughout the industry. What's been very clear, though, is you have been seeing value is certainly in vogue, and that quick service traffic has been outperforming the broader industry. And I think that's likely to continue for the foreseeable future. And so Domino's has the unique wrinkle that delivery sales in the pizza delivery category are the one spot of softness within quick service. And we expect that to continue to be very clear. However, there's enough drivers here in place for Domino's that we think will get them back to positive delivery traffic while recognizing the undertow in delivery sector challenges likely continues.
Does Domino's need to raise prices from your perspective?
I think it's going to be minimal. We've seen cheese prices correct heavily at the beginning of this quarter, but they've kind of come back as they overcorrected earlier in this quarter. And so we expect some modest pricing. We expect some modest pricing in the neighborhood of about 1%. Pizza by nature is a very promotional category. They're very steadfast with the $6.99 mix and match platform that was raised earlier this year. Back in 2022. So I think you're going to see some modest pricing here, but I think it's going to be quite minimal.
As you point out in your note, Domino's does trade at a premium to some of its peers here. I know you went to an outperform, so I guess this is sort of implied, but how is that premium justified at this point?
So it's interesting. Historically, the rough ranges, if you look at FY2 EBITDA, the rough ranges trade somewhere between flat with its global quick service S&P constituent peers of Yum and McDonald's. It can go all the way to a 40% premium. And if I go really extreme, it can go 54% is kind of where it's peaked out. So, right now we're kind of in the mid-teens in terms of where that premium is. So below the midpoint of the range, the historical average range, somewhere around, kind of where it's historically traded. But the upside here will really come from execution, that if they get same-store sales going in the right direction, the multiple will certainly follow. And I just reflect that as well, that, you have, when you look at it on versus the S&P 500, on a PE basis as well, kind of similar, that it's trading kind of near the historical range and historical average, but certainly room for upside, especially if they're executing.
Andrew, we kind of gave acknowledgement to the fact that Domino's was very early on in being a digital kind of either transformation story or even disruptor in the way of ordering pizza as well here. All that considered, is generative AI something that analysts like yourself expect this company to be able to successfully infuse, and what type of, multiple or even just quantitative aspect does that add in or layer into the McDonald's overall kind of pie, if you will?
Yeah, we could certainly talk at length about this. And with Domino's being such a digitally savvy restaurant company, I think it fits really well to really benefit, from this. And so maybe just a punchline would be that on the voice AI side, for their phone orders, which constitute about 15% of sales or so, there's still people phoning in. Replacing that human being answering that phone with the equivalent of Alexa or Siri. And this is something that Domino's is piloting, the ability to do that. So that way it makes it easier for the operations inside the restaurant that you don't need someone answering the phone. Instead, they can be helping with guests inside the restaurant or with the preparation of pizzas. The fact that it's your best customer service representative, the AI, that it asks every time around popular upsells. Similar to what we were talking about a minute ago, on the digital side, that this is what the AI could do for phone and orders. And, the fact they're collecting quite a bit of data, on customers versus relative to the phone and orders, certainly that's a big opportunity. Get those customers to come back for digital. And so that to me is the big opportunity and unlock here around where AI can really fit into Domino's businesses around those orders and making sure that the orders are being taken seamlessly, efficiently, and really eliminate redundancies inside the restaurant.
Andrew, before we let you go, what's your Domino's order?
This is going to be very controversial, unfortunately. I'm a pineapple on pizza kind of guy, and that's my kid's favorite topping as well. So that's what we do in the Charles household.
My 11-year-old also is a pineapple and pizza guy. So you guys have that in common. Andrew Charles, thank you so much. Senior Research Analyst at TD Cowen. Appreciate your time this morning.
Thank you.
Well, 3 companies are partnering to bring battery cell production to the U.S. The joint venture is going to be dedicated to accelerating and localizing battery cell manufacturing to the States. Tell us more about this and who is involved. Yahoo Finance's Prosubramanian is joining us. So who's partnering up here?
Hey, Julie. So it's basically Accelera, which is engine maker Cummins' zero emissions arm, partnering with Daimler Truck and U.S. truck maker PACCAR, which is behind brands like Kenworth and Peterbilt. They're forming a joint venture to make battery cells for commercial vehicles and other industrial applications. The JV will make LFP type batteries, which are cheaper and better for heavy use and shorter distances, perfect for short-haul trucking. So the companies say the total investment will be around $2 to $3 billion with the 21 gigawatt hours of annual output. The JV did not say, however, where they'll actually build this factory, though perhaps near a Cummins or PACCAR plant in the U.S. But I got to say, Julie, it's another win for the U.S. and EV battery investment in this country.
And similarly, we're also seeing automakers investing in EVs in the U.S. So how does this project then fit into that bigger picture?
So earlier today, the Blue Green Alliance, which is a foundation that tracks sort of clean energy investment and environmental issues, tabulated some data and found out that through the last couple of years, the amount of total EV investments in batteries and plants and things like that is $154 billion in total investment, and leading to about 188,000 total new jobs across the country and in that growing battery belt in the center of the country. So top 5 companies in terms of spend are LG, Tesla, GM, Ford, and SK Innovation, which is the South Korean battery company. So, a lot of big deals in this space, more investment coming. Let's face it, it is, like I said, a big win for the White House and also backers of manufacturing here in the U.S.
And so who right now, just as the broader context here, is the battery leader, and who is making the best effort to really try and cut into that market share?
In terms of making the most batteries in the U.S. or investment, I would say it's LG. They have the biggest investment, around $17 billion so far in the U.S., and they make batteries for GM, Ford as well, just sort of across the board there. But you see more from Tesla, Panasonic, and also SK Innovation, which is Ford's big partner. They're helping Ford build a big plant in Tennessee and Kentucky that's coming up probably next year.
All right, great insights as always. Pras, thanks so much for helping us break this down. Appreciate it.
Thank you.
A report out this week says China's services activity hit an 8-month low in August. China's slowing economy has been ongoing for the past couple of months and shows no signs of getting better. To talk about China's sluggish economy and its effect here in the States, Yahoo Finance reporter Josh Schaefer. Hey, Josh, what are we tracking?
Yeah, Brad. So, I mean, there's a little bit of a debate here, right? You could argue sort of how much China's slump matters for the U.S. and sort of where to focus on that. But I found an interesting note yesterday out from EY and our friend Greg Daco, who I know is on the show a lot. And he sort of pointed out that while when you look at the distribution of GDP, if China were to see a significant downturn in GDP, when we're tracking things like services, we're tracking economic growth, right? So if we're tracking that to fall down, then you wouldn't see that big of a decrease in US GDP, but you have to consider if China were to slow down, how it would impact other countries. And that was sort of what stuck out to me. And so essentially what he said was if economic activity significantly turned down in China, then maybe it would turn down more globally. And then when you think about the global slowdown, then that leads to a bigger issue for the US, which stuck out to me because right now I think also in a slower economic calendar week for us here in the US, we're spending a little bit more time looking at, say, China and maybe Germany and looking at the other big economies and thinking about how that might impact the US, because it's been interesting. We talk a lot about resilience here in the US, but you take a look at data out of Germany with the factory orders coming out today, weaker than expected. So the data in Europe has not really matched the data that we've seen in the US, and they've seen a little bit slower economy growth over there. So how that ends up impacting us is something to start thinking about here.
Right, and that drop in Germany, so much so in July that it's actually worse than what? Since what kind of marker are we looking at here? Since the height of the pandemic in 2020.
Yeah. And so to think about that, and that's the third largest economy in the world, right? So that economy starts slowing. That means that they're going to start also slowing where they interact with other countries. And then eventually at some point that comes back to root here in the US would sort of be the theory there. Now we're obviously extrapolating a little bit far right now and wondering where it comes down the line. But it'll be interesting and something to track.
Sure.
Right, and it's been U.S. consumers up until now that have sort of made the U.S. economy more resistant to all of these things we're talking about, seemingly, right? At least that's what it feels like up until now. So I guess it's all of these sort of marginal things that have to keep working. So if the U.S. consumer, as some are predicting, work down their excess savings, have to start paying back student loans, and then that sort of gives at the same time the U.S. companies that rely on China or Germany are also rolling over, then perhaps could start to become more of an issue.
And the other interesting sort of rabbit hole I went down yesterday, just thinking more about this and a lot of the coverage that's been out there about the Chinese economy and why it hasn't been working, something that stuck out to me when we talk about the consumer, is just how different that Chinese consumer is and what they're willing to spend on versus the revenge spending we've seen in the US. There's a couple great reports out there just basically saying that that economy and that consumer is just not the same as the US. So when you're considering and looking at that economy, you can't really treat it the same way, which I found pretty interesting as well to think about. Revenge spending here is basically a given, right? We all went back, everyone went to Vegas or did something flashy, and Macau saw a little bit of that pickup in, say, an area like Asia, but they didn't see that kind of pickup, and they haven't seen it in restaurants and services either. So it's been interesting to track sort of a slower consumer there and not as much of revenge spending, I guess.
Right, I guess so. All right, Josh Schaefer, thanks so much. Let's do a check on the markets now, because we have seen things sort of deteriorate since the beginning of the session to some extent. We talked earlier about the ISM manufacturing report coming in better than estimated, and stocks taking more of a leg downward after that. If you take a look at the Wi-Fi Interactive, I've been watching bond yields as well today. They're not moving that much, but we see 4.29% on the 10-year. It's up a couple of ticks in today's session. And if you look at the 1 month here, you see sort of the round trip it has made, but still remaining at relatively elevated levels. That has proven to be kind of consistent, well, not that consistently, but sometimes problematic for the likes of the Nasdaq 100, which you see here. And indeed, you see some declines accelerating for some of these Nasdaq names in today's session, which is quite interesting here to see an NVIDIA down 3% without really any specific news here that is hitting this, but it's been accelerating to the downside ever since the open.
Yeah, for a hot second, I want to focus in on Alphabet, Amazon, Apple, Meta, and Microsoft. They actually were designated for the first time as gatekeepers under the European Commission, and that designation essentially, they can designate digital platforms as gatekeepers if they provide an important gateway between businesses and consumers in relation to core platform services. It comes after a 45-day review process. This has just dropped this morning from the EU under their Digital Markets Act. So keeping a close eye on those companies as we move forward with regard to some of the trading activity activity for Alphabet, Amazon, Apple, Meta, and Microsoft right now.
Yeah, and those stocks a drag there, as we showed, although consumer discretionary is still the worst performing group, but Amazon is in that group. Yeah. Well, that's all for us. Rochelle Akufas got you for the next hour of trading. Stick around.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Big tech companies are facing new antitrust crackdowns in the EU. We'll discuss the companies juggling the new restrictions this hour. And as student loan repayments get set to restart, how should you be planning your budget? We'll give you some top tips. Plus, from AI to streaming, our very own Brian Sozzi is at the Goldman Sachs Communacopia and Tech Conference, and he'll be bringing us conversations with chief execs from Okta, Hasbro, and Paramount this hour. You won't want to miss that. But first, let's check in on how the major indices are doing an hour and a half into the trading day. We see all three under some pressure here. The Dow currently off about 0.5% here, about 180 points. The S&P 500, they're also seeing strain there, down about 37 points or 0.8%. Tech-heavy Nasdaq also under some pressure there, as we saw from that news on that EU ruling as well, sending a little bit of jitters through there. Seeing that down 155 points or down about 1% on the day. Let's also check in on the Treasury market as well, as we saw the US service sector picked up unexpectedly in August, putting a little bit more pressure on some of those inflation concerns. We're seeing the 5-year, though, seeing some gains up about 1.33%. The 10-year still solidly above that 4% mark, but currently up about 0.5% on the day. And taking a look at the longest term 30-year yield, the only one in negative territory so far this morning, down about 0.4%. Well, 2023 has been a defining year for artificial intelligence. Investors have poured money into stocks like market leader Nvidia and Microsoft over its AI plays. Now, Wall Street has certainly been bullish on some of the bigger players, and in a note titled "Why AI is Not a Bubble," Goldman Sachs disputes any signs of this trend popping, saying, quote, "We believe we are still in the relatively early stages of a new technology cycle that's likely to lead to further outperformance." Well, for more on AI, I'm joined by Jay Jacobs, US Head of Thematics and Active Equity ETFs at BlackRock, for this week's ETF report sponsored by Invesco QQQ. Good to have you on the show, Jay. So, as we've seen here, a lot of people are wondering if, since it is so early, trying to determine how can we can even tell if it's overhyped or underhyped at this point. What are your big takeaways here?
I think the big takeaway here is that most of AI stock market moves this year have been really concentrated in just a few names. Some of these mega cap tech names that, to be fair, are massive AI platforms and really some of the pioneers in the space. But this is a $15 to $20 trillion theme over the coming decades. This is going to massively upend several aspects of the economy, not just technology, but if we look at healthcare, if we look at services, we look at productivity, it's going to have a really incredible impact. And so being so narrowly focused on just a few mega cap names really misses kind of the breadth of the opportunity within AI in the coming years.
And you do note that it's really also about the value chain of companies that will also benefit from AI. And you put them in a couple of different buckets here: developers, enablers, and beneficiaries. So when you're thinking of sort of the sorts of industries that come under each of these, which ones are you focused on?
Yeah, so a lot of those mega cap tech names are really the developers. They are building the cutting edge AI platforms like ChatGPT that we think are really going to be kind of leading AI platforms. But when we think about the next stage of growth for AI, a lot of roads lead through enablers like semiconductor manufacturers, people who build the GPUs and the CPUs and the networking services and the digital infrastructure that's really going to power this massive amount of compute that's needed to power these AI platforms. And then finally, if we look a little bit further downstream, I think we have to look at who are some of the early adopters of AI, who are incorporating this into their products. For example, we see a lot of travel companies right now are using AI as ways to make kind of recommendations on what your itinerary should look like if you want to take a fall trip. But that's just the tip of the iceberg when we see other use cases. And those early users and those early adopters are likely to really see some kind of massive benefit from adopting AI faster than the market.
So when investors are thinking of this, because initially, obviously, it came through some of the biggest tech names, but because it will touch so many different industries, how should investors be approaching this, especially as we look at ETFs that would really help them capitalize on this when we still really don't know exactly who the big players are all going to end up being in these early stages?
Yeah, absolutely. So I think the first step is investors have to understand, what exposure do I already have to AI today? We looked across thousands of financial advisor portfolios and saw that in people's stock allocations, they had about 20% exposure to AI names already. So there's already a very big allocation to AI just by owning kind of market cap weighted indexes, again, through those mega cap tech names that have been big beneficiaries this year. So the next step, beyond just kind of measuring what you have today, is really thinking through what are the downstream impacts of AI, who are the beneficiaries over the next 12 months, 36 months, and ultimately 10 years. That's where we look further down the supply chain here. This is where we look at those enablers with a real focus on semiconductors through our SOX ETF, SOXX, or looking at some of those users that are adopting AI technology in the early stages. All of this getting captured in our IRBO, robotics and artificial intelligence ETF.
And for some people who are a little bit more cautious, you do have some of these buffer ETFs on deck as well, looking at IVV, IVVM, IVVB. Break down how those would really benefit investors as they try and approach this, but perhaps in case they're a little bit more risk averse.
One of the biggest opportunities in the market today is not necessarily trying to pick the next big winner. It's just getting invested. If you look at average allocations across advisor portfolios, we have seen the largest allocation to cash since we've been measuring this. It's about 6% of a 60-40 portfolios in cash right now. So bringing that money off the sidelines is a really important step towards wealth creation for any investor. But we know that not every investor is going to be looking at high growth opportunities or necessarily wants to have full equity market risk. So that's why we brought out our buffer ETFs, IVVM and IVVB, which use option strategies that are fairly commonly used in financial services, but wrap it in the efficiency of an ETF. The benefit being it provides a measure of downside protection if the markets sell off, in exchange for capping some of the upside if markets begin to rally.
And just quickly, Jay, as you look at some of the fundamentals of these companies that are all sort of touting their AI possibilities from this point, what are some of the key things that you look for when you're deciding who's really going to have the longevity in this space?
Well, we really look for kind of the purity within these names. So are these companies truly committed to AI? Are they building AI platforms? Are they enablers of AI platforms? Or are they already integrating it into their products? I think there's a risk out there that some companies and names are talking about AI in a way that's really more on the marketing side of things. You really need to focus on who are the pure play companies that are really driving this theme forward. That's where the opportunity is. And that's why we really like semiconductors and kind of the broader ecosystem with IRBO.
I do appreciate you cutting through the noise there, because I know a lot of investors wondering, with this fear of missing out, what they should be looking at. So good to have a level-headed approach here. A big thank you to Jay Jacobs, US Head of Thematic and Active Equity ETFs at BlackRock. We appreciate your time. Thanks so much. Well, big tech companies have a whole new playbook for operating in the EU. On Wednesday, the EU's competition authority named 6 companies and 22 of their subsidiaries as, quote, gatekeepers. Now, that changes their rules for competing against smaller firms. Yahoo Finance's Alexis Keenan has more on that. So, Alexis, what do we know so far?
Hi, Rochelle. Yeah, take a look. We just had it up on the screen there. The list of these big tech companies that were just revealed today by the European Commission, that's the antitrust regulator there, as gatekeepers. These 6 companies, Alphabet, Amazon, Apple, ByteDance, Meta, Microsoft, plus 22 companies totally, including some of their subsidiaries. They're going to have to overhaul their business models and stop doing some of the practices that have really helped their bottom line over the course of their history. Now, that's all due to the EU's new Digital Markets Act. It becomes enforceable in March. So these companies are going to have to comply by then, get their ducks in a row. And what this law does is it makes it illegal for these companies to do things like favor their own products over other businesses that are using their platforms. Also makes it illegal to wall off some of their ecosystems. Also, they can't combine user data, personal user data across their different platforms. They're going to have siloed those off from each other. So, for example, Amazon.com, they're not going to be able to boost their own products over the third-party sellers on the platform. Meta and WhatsApp, WhatsApp is going to have to be able to work with other messaging services. And then you have operating systems in there, mobile and otherwise. They're going to have to let in third-party app stores. They're also going to have to let app developers allow for alternate in-app payment options. So Microsoft and Apple already asking for some exemptions to this coming law. The EC is evaluating those requests. They specifically are for Microsoft, saying that its Bing, Edge, and also its advertising arm should be exempt. As for Apple, it wants its iMessage platform to be exempt. The company notes and makes a distinction between personal messaging and business messaging, and saying that, may be okay for business messaging, but they don't want that to happen on the personal side. Apple also saying here that they are very concerned about privacy issues, and so they want the EC to address that. But Rochelle, the fines here for violations of this law, they're steep. They're up to 10% of total annual worldwide revenues for these companies. Also, for repeat offenders, they can go as high as 20%. Not to mention, there's also the option for the EC to look for divestiture for offenses that are multiple offenses of these laws.
Certainly would be a huge deterrent there, and really almost a slap in the face for a lot of these companies who really prize themselves on having these ecosystems. We appreciate you getting us up to date on that. We'll see how that plays out. A big thank you there to our very own Alexis Keenan. All right, we still have all your markets action just ahead. Stay tuned. You're watching Yahoo Finance.
Seoul has more Starbucks stores than any city in the world, but Dan Halley isn't looking for a brown sugar shaken espresso. Find out why he's there on Yahoo Finance's next.
Hello, yes, I can hear you. Let's do a check of the markets sponsored by Tasty Trade. Still seeing the major indices under pressure here, that selling action picking up. As we see the Dow there now off more than 220 points. The S&P 500 there also down more than 40 points or 0.9%. Tech-heavy Nasdaq there also seeing a blow, down about 1.25% or 171 points. Investors mulling the EU's antitrust crackdown on those big tech names. And then US services PMI picking up, showing inflationary pressures on some of those input costs for businesses still weighing on them. Well, after years of holding out hope that their student debt would be forgiven, borrowers are moving on. The Department of Education sent record payments, $6.4 billion, to the Treasury in August as debtors started making student loan payments once again. But there's hope yet for those waiting until payments are required again in October. Yahoo Finance's Danny Romero joins us with more on that. Hey, Danny.
Hi there, Rochelle. Well, it's that time of year to start thinking about budgeting, especially as student loan repayments are set to be due. There's been much discussion about that SAVE plan and how it works. Well, we're going to break it down for you by using one of our viewers' question. Here it goes. Here it is. If I make $68,000 as a single person and my payments are at $312, is it worth it to apply to SAVE? Before we jump in and calculate those monthly payments, we need to figure out what is Molly's discretionary income. That is the income that's left over after you pay those basic needs like food and rent. And how we're going to calculate that, we're going to use the U.S. Department's Health and Humanities Service Poverty Guideline. That's on the studentaid.gov website. So for this person, specifically Molly, it is $14,580. We're going to multiply that by 225%, and we get $32,805. This is the poverty line. Now we're going to subtract that from her net income and get her discretionary income, which is $35,195. Then we're going to multiply that by 5%, which is under the SAVE plan, and we get $1,759.75. That is an annual payment, but then we're going to divide that by 12, and we get the monthly payment of $146.64. So definitely, Molly, your answer's here. You're going to pay less under the SAVE plan. Rochelle?
Appreciate that. So then, Danny, what's the latest about New York City's Airbnb crackdown for people who were hoping to make perhaps a little bit of extra side cash with their Airbnb?
Rochelle, New York City's rental market is going through a little bit of a shakeup right now. As of Tuesday, just yesterday, a new law went into effect that affects landlords who have short-term rental leases on platforms like Airbnb. They are required now to register with the city. So how this works is that hosts cannot rent out their entire apartment for less than 30 days, and the landlord has to stay in that apartment if they are renting it out. Another thing is that reservations are capped out at 2 guests, and penalty fines are up to $5,000 per violation. There's about 40,000 Airbnbs in New York City specifically. City council members, this has been a big debate on whether or not rents have gone up because of this reason, that landlords are scooping up this inventory that is pretty much set to be for the rental market. But Airbnb says this is a blow to the tourism of New York City. Now, the test will really come to play on how New York City will regulate this. I've heard from countless Airbnb hosts that the registration to register their property for the city has been very difficult and very time consuming. So again, this will be the test for New York City on how they regulate all these laws and how this will all take to effect. But I will say, Rochelle, New York City isn't the first city to do this. We've seen this across the country in Dallas and Palm Springs, California. So there definitely is a lot of spotlight on how these Airbnbs or rental properties are regulated, Rochelle.
Indeed. So for people who are hoping that could be their side hustle, please pay attention. Do not end up getting fined, as Danny has broken down some of these new regulations for New York City coming into effect. Big appreciation there for our very own Danny Romero. Well, top executives from across the tech, media and telecoms landscape are gathered in San Francisco for the Goldman Sachs annual Communacopia and Technology Conference. At the top of the attendees' agenda, the role of AI in the workplace and how companies can win across the evolving tech ecosystem. Yahoo Finance's executive editor Brian Sozzi has been speaking with leaders in the space about the emerging technology's potential. We've got one of those conversations right now.
All right, joining me now is Okta co-founder and CEO Todd McKinnon. Todd, weren't we just here doing this?
Another year, another Goldman Sachs conference.
Yes,
it's great to be here.
Well, thanks for joining us.
Yahoo Finance.
I appreciate you always coming on with us. Now, I read a note recently about Okta, and it said, Okta is due credit for improved execution. Do you think Okta is getting enough credit for all the turnaround work you've been doing since we last saw you at the Goldman Conference?
Well, we've been working hard, and I think what people are looking at is you're seeing a company that is able to grow revenue 23% in the quarter we just reported, and also generate significant amount of cash. We generated almost $50 million of cash. And so this balance of growth and improving profitability is pretty attractive, especially when you consider the really big markets we're going after. So we've improved, we want to continuously improve, and we're excited about the trajectory we're on.
At a conference like this, what are some of the questions you're getting?
So they want to know about the big picture, but they also want to know about the proof points to get there. I think one of the biggest difference in the last 2 years is that, yeah, of course, investors are always worried about the big secular trends, the companies that could be big, the markets that could be big, but they want more proof points about how you're actually getting there. What progress have you made in the short term and the medium term? Before you can talk about that forest, they have to see a few more trees, which I think is a healthy thing for all of us.
The enterprise business for Okta, what's the health and status of that business?
Well, when you think about the whole macroeconomic situation, one thing we've observed in our business is that smaller companies, if you're a company with just a couple hundred employees or 50 employees, you're being pretty cautious with your spend overall, and specifically your technology spend. Larger enterprises, they've kind of locked in their budgets at the first of the year, and they're executing now. And you saw that with our quarter we just reported. Our top 25 deals in the quarter were $100 million of total contract value, which is incredibly healthy. The cohort of $1 million plus ACV deals was one of the fastest growing in the history of Okta. So I think you're seeing a big strategic priority for identity, and you're seeing some stability in the budgets of larger organization, which is driving the results we delivered.
And that's one of the call-outs from your most recent quarter was the ability to win bigger deals, maybe bigger deals than you had been winning in prior quarters. What do these companies want from a company like Okta at this point in their lifespan?
Well, they want a few things. The first thing they want is they want to improve their customer experience. You know, people are talking about cost and efficiency, but at the end of the day, businesses want to grow revenue, they want to cut costs, and they want to eliminate risk. And we can help them do all of that. We can help their customer retention. We can make a better experience on their mobile app or their website. We can help them convert users from anonymous to logged in users. We can help them do that more effectively and efficiently, and they could do that by writing their own code. In fact, one of our customers is OpenAI. We're the login for ChatGPT. So the developers at OpenAI didn't build login. They focused on AI, and I think that was the right decision for them, and their success would say the same thing.
OpenAI is grown like a juggernaut. How is that growth translating to growth for your company?
Well, it's an important growing customer for us, but and we're focused on making them successful like all our customers. But I think the most exciting thing I am about it is two things. One is that I think there's going to be 1,000 new technology companies with great apps and services delivered around AI. And those are all going to need identity. The next Salesforce automation or the next finance management or the next, all these categories are going to be revolutionized by the AI technology, whether that's in some categories like CRM, maybe it's CRM that does it. But in a lot of categories, it's going to be new companies, new technology, all that need identity. And then when you take them in a workforce setting, the enterprises that are absorbing all this technology, are going to need a great workforce identity solution to secure it and manage it and make sense of it all. And we can help them with all of those.
Is the hype around AI real? Does it deserve to be as hyped as we're making it out to be?
So here's the thing. I'm a pretty even-keeled guy.
Yes,
I don't get too excited about things. There's a lot of hype in our industry. I think this may be underhyped. I think it impacts things at so many levels. It impacts how we, what we drive, what we don't drive, what drives itself. It impacts how we interact with computers and how they seem personal. It generates how art and media is created. It's really a breakthrough in computer science, and it impacts not only the products, but it impacts how software is created. AI tools can help us make better software, whether it's development copilots or software that can, in some cases, write itself or improve itself. And that's pretty profound at different levels of the tech stack. So I think the industry is really has a powerful macro driver for a long time.
Do you view Okta as an AI play? Do you even think about it like that?
I think it's almost like a trick question, because everything's an AI play. When every company needs a technology strategy and all of technology is being impacted by AI, every company by extension is an AI company. So I think it's a little bit, you have to say yes to that. Now it's the specifics around how you benefit. Well, I think we can benefit from multiple ways. One is we can provide picks and shovels to the miners. We can make sure that people building AI technology and trying to make it secure and trying to get it delivered to enterprises and consumers can have a great identity infrastructure to do that. And we can make sure that we can use AI in our own products, whether it's detecting threats or building better recommendation on how to use and set up Okta. We'll be talking a lot more about this at our conference coming up October 3rd here in San Francisco, Octane. So make sure you come see us for that.
Anything you can tease?
Well, it's like, not surprisingly, if I say AI is underhyped, we're going to try to hype it more, right? So you can see us there. And then the last thing is that we have to make sure as we run our company, both from the products, but also how our business processes and the technology we use, we have to make sure that this AI, the potential is put to good work inside of our company as well. So yeah, I'm very excited about it. As the industry in a warranted way should be.
I was talking to a CFO of another tech company at the conference, and they were talking about how it's hard to find talent to support these AI initiatives. Do you find it hard to find the talent you need to implement all these AI initiatives?
Well, I think it's always hard to find great talent. I think that, anyone that's been in technology or been in a growth company or try to do more with technology knows that talent is really important, and it's always a challenge. I think the thing about AI is there are researchers and experts, and that's a very, very rare skill and very prized possession. But I think a lot of the industry is learning together. They're learning about the potential of these things. They're learning about how they can put into products. And I think with a smart, engaged workforce that's motivated to deliver on what Okta's trying to do, we're in a good position to bring on new people that have this expertise, but also to take all of our entire teams and learn about AI together with the whole industry to take us to the next level.
Okta co-founder and CEO Tom McKinnon, always great to get some time with you. Let's do this again next year.
I'll be here. See you then.
Appreciate it. All right, guys, back to you. Much more ahead from the Yahoo Finance's coverage of the Goldman Sachs Tech and Media Conference here in San Francisco.
Did Dan Howley go all the way to Seoul for some light shopping? He's no doubt a tech aficionado and the citizen of the world. You need to know what he's up to. We'll find out when Yahoo Finance is next.
Welcome back to Yahoo Finance Live, and we're still stationed at the Goldman Sachs Tech and Media Conference, but why not talk some toys as the holiday shopping season gets ready to kick off? Joining me now to talk some toys is Hasbro CEO Chris Cox. Thanks for joining us.
Thanks for having me, Brian.
All right, so what brings a toy CEO to a Goldman Sachs Tech/Media Conference?
Well, we're also a game company, so games is a lot of technology, particularly our digital games.
Take us through your digital journey. We'll talk about how the holiday season might play out for you guys, but where are you at on digital, and how large is your digital footprint inside Hasbro?
Well, right now our overall game footprint is about $2.1 billion. It's by far the most profitable and highest growth aspect of Hasbro. And digital games right now is about 25% of it. And as we think about digital games, there's really kind of three businesses. There's a licensing business, there's a games as a service kind of business, and then there's AAA publishing that we're also developing.
These are some big numbers. Do investors appreciate the growth potential of a business like this?
I think a lot of them do, and the ones that don't are starting to really wake up to it. Like, when I started at Wizards of the Coast back in 2016, that was 15% of Hasbro's profitability. It's now over 50% of the profitability of the company.
Are you still gaming?
Yeah, oh yeah.
Do you have any hits?
Oh, for sure.
Right now, what is the trajectory of the games? What's in the market and what's coming?
Well, Baldur's Gate 3 just launched on PC. It's going to be launching on PS5, I think today or tomorrow. It's one of the best rated games in history. I think it's got a 96 or a 97 on Metacritic. The only games that have that are like GTA and Zelda. And it's tearing up the charts. We also have Monopoly Go. It's the #1 game across iOS and Android in terms of mobile.
What are your big bets on digital and the gaming platform for next year?
Well, we continue to invest in our licensors. So, I think Scopely and Monopoly Go and Baldur's Gate 3 is going to have a really long life for us. That's probably, when you look at our overall licensing portfolio, it's over $100 million, $150 million of very high profit revenue for us. We have games as a service like Magic the Gathering Arena and D&D Beyond, which also are super high profit and high growth businesses for us. And then we're investing in a lot of our own publishing capability, and I think you'll hear about us announcing a couple of those games over the next couple months, and we're excited for that.
Do you want to announce them now?
No, I can't.
One of the main themes at this event, of course, is AI. Does AI change how you develop a game?
Oh, for sure. I think AI changes. I think AI is going to change any creative industry. I think the important thing is you have to adopt a creator-first mindset, though. Creators are super important to us. We hire and employ, over 1,000 artists and designers across our company, whether they work for Hasbro or they're contractors that we work with. We got to make sure anything we do with AI thinks about them first. But I think any creative would admit that AI is transformative to how they think about and how they concept new ideas. So I think it's going to be very exciting. It's still early innings, and we got to figure out how to do it right. And we got to make sure that we always remember that humans need to be at the center of any kind of solution.
Are we just headed into a decade of just creepy toys with AI, like creepy dolls? Is this what we're looking at now? And how does that change how children interact with these things?
Well, I think like with any technology, you have to think about it responsibly, and you have to think about how they cross the chasm. So I think there's a big hype cycle around AI right now. Probably it's going to need a couple years to really kind of mature and make sure we have the right guardrails associated with it. But I think like any new technology, companies need to invest in it, figure out how to utilize it.
On another note, a non-Goldman analyst a couple weeks ago published a note on Hasbro saying you have undergone some of the most intense change out of any company they cover. Where are you at in turning around a Hasbro?
Well, I think it varies based on the aspect of the business. So Hasbro really has three businesses. We have entertainment, we have toys, and we have games. In entertainment, we're in the process of right-sizing that business. We just announced that we're selling our film and TV division called E1. And I think we'll have a much smaller but more strategic footprint as a result of that. In games, that's all about growing the hot hand. That business has grown at double-digit CAGR over the last 5 years. We continue to see very robust growth prospects for it, and it's at a very rich margin for us, 30% plus margins. So we'll continue to lean into that. In toys, I would say that's more of a turnaround for us. And right now with toys, we're about bringing on the right people, establishing the right mindset, and executing like crazy. And I'd say we're probably in inning 2 of that, but we're starting to see some nice results from it.
What have you identified in terms of toys that need an improvement? Are you not putting out the right toys in the market? Has the market itself changed?
Well, I think we have no shortage of great creative ideas. I think what we needed was better process to be able to vet what the ideas that we need to bring to market should be, and then more consumer mindset in terms of consumer research, data analytics, and an understanding of our channel partners and what they need. I think if you pair like good process with the great creativity, and especially the outstanding brand portfolio we have, you're going to see a pretty good turnaround from us over the next 18 to 24 months.
We're hearing a lot from major retailers. Delinquencies on credit cards are on the rise. The consumer is cautious. What's your expectation of the holiday season as pertains to the toy business?
Well, I think it's a mix of headwinds and tailwinds in terms of the consumer right now. You know, the fan economy still is really robust, and Hasbro has great exposure there with games like Magic the Gathering, our fan business, which is a lot of Marvel and Star Wars, Dungeons and Dragons. I think the more general consumer still has a very good employment kind of set of prospects. Employment rates are still at historical lows, but there's a lot of debt piling up. There's a lot of interest rates that are starting to climb on mortgages. Student loans are starting to come due again. So, you know, we're going to need to see those headwinds and tailwinds kind of bend a little bit more towards tailwinds to make sure the toy industry stays healthy.
One of the tailwinds that some folks that cover Hasbro saw was a slowdown in inflation. But now oil prices are back on the rise. What's your inflation outlook? Obviously, oil is a critical ingredient or input to how you make a toy.
Well, in general, we lock in our prices about 12 to 15 months in advance. And so we're actually seeing deflation in the cost of our toys. You know, if you look at the general toy industry today, we started to see a slowdown in Q4 of last year in toys, and that's extended into this year. You know, right now, the general industry is down mid-single digits to high single digits. Our hope is we start to see a turnaround in September and October where at least we start to get flattish. You know, Hasbro, I think we feel pretty good about our product portfolio and our ability to execute, but it's got to be an industry thing. We've got to do it with our retailers, we've got to do it with our other partners to see that turnaround happen.
All right, well, we look forward to continuing to follow your journey. Hasbro CEO Chris Cox, enjoy the rest of this Goldman Sachs conference.
Hey, thanks so much.
Appreciate it. All right, guys, much more ahead on Yahoo Finance Live, including more coverage of the Goldman Sachs Tech and Media Conference. We'll be right back.
Now, from the Lower East Side to the heart of Seoul. For some men, I guess all the world is a catwalk. But why is our tech wizard Dan Halley strutting down one of the Korean capital's most famous shopping streets? Well, we're not going to tell you just yet. Find out on Yahoo Finance's next.
All right, welcome back to Yahoo Finance Live. We're still stationed at the Goldman Sachs Tech and Media Conference. Here we're going to drill into all things media now. Paramount President and CEO Bob Bakish joining us. Bob, good to see you again. Thanks for joining us.
Great to see you.
Talk to us about some of the questions you think will be coming at a Paramount at an event like this.
Questions? Well, certainly the Charter Disney thing's a topic of conversation. Strikes, topic of conversation. Ad market, topic of conversation. Streaming writ large, topic of conversation. So there are plenty of things to talk about here. And fundamentally, our point of view is we're continuing to push Paramount forward, transform the company. We're arcing through our peak investment year in streaming, returning the company to total company earnings growth next year. And we're feeling good about all that as we navigate, some short-term challenges.
Talk to us about your streaming initiatives. You've had a lot of big hits, of course, Yellowstone, 1883. So this year is the peak investment in DTC or direct-to-consumer. Is that a profitable business next year? Is that another way of looking at it or not yet?
So we're thrilled with what we've built in streaming in a couple of short years. Obviously, that starts at Paramount Plus. Over 60 million subs as of the second quarter, 50% revenue growth in the second quarter of 23. Yes, we've been investing in it, and as you said, 23 is our peak investment year, but we've got real momentum there. We set out with a broad thesis to build a cornerstone service for consumers. We call it news, sports, and a mountain of entertainment, and we are seeing that very much come to pass. Business continues to scale, yes, it's an investment, but that investment is paying off, and people will see that continue to go forward in the marketplace, attract fans such as yourself with great shows from Taylor Sheridan or the NFL, which thankfully is coming back this week, college basketball, all kinds of stuff. So we feel great about our streaming product.
You mentioned the Charter Disney situation. What is your take on that? And what would an outcome there mean to a Paramount?
Well, look, obviously a lot of conversation about it. Frankly, this is something that we saw coming years ago, and we set out to build a company that would transform along with the consumers, and that goes to our asset portfolio, it goes to how we think about distribution, it goes to relationships. We have very much transformed Paramount. If you look at it with respect to distribution, we now have co-marketing agreements for our streaming products with virtually every major MVPD and VMVPD here in the U.S., where we have a shared participation in this consumer transition, including streaming, point one. Point two is, if you look outside the U.S., we've actually taken that a step further with these hard bundles where we provide Paramount Plus to a whole tier of a traditional distributor subscribers, like Canal, with Sky, et cetera. We love the financial expression of that. We love how that scales our business. Point three is you look at distribution here in the U.S. and skinny bundles like Charter Spectrum Essentials, which is a topic of conversation vis-a-vis the current situation. We've been there. We are there. We like that. That sector of the market is growing. It's important to be included in it. Again, it is part of this consumer transformation. And we're taking probably the most important step today with Paramount Plus with Showtime, which is a true multi-platform product, available on linear, available on streaming, obviously. And one of the things we're doing on linear is for a traditional Showtime subscriber, soon to be a P Plus with Showtime subscriber, they're getting credentials to the apps. We have that deal in place with multiple MVPDs, VMVPDs, among the biggest ones here in the US. We are thrilled with the financial expression of that deal. And again, it's about transitioning consumer behavior. It's about looking forward. And that is very much what we're doing. So my point is, all boats are not created equal. We've been on this for a while, and thankfully, we don't have a 100% sports product, which I think provides some particular challenges in this regard.
But I see the product, I see the IP that you have, the NFL, you look at things like Yellowstone. Are the distributors undervaluing the power of the content that you create?
Look, Sumner Redstone, may he rest in peace, said it long ago, content is king. People don't watch apps, they watch content. And again, thrilled the NFL is coming back this week. NFL has been a great audience vehicle in traditional linear television, which it helps make CBS the #1 network in the country now for the 15th straight year. And it's great on Paramount Plus, both in acquiring subs and in engagement, i.e. keeping them entertainment. And that's just one piece of our thing. So yeah, I think distributors understand the power of content. I was talking to MVPD CEO last night. They understand the power of content. The focus has to be that we together modernize these relationships. Just like Tom Rutledge, then CEO of Charter, said after our last deal on his earnings call when we were called Viacom CBS, he said the new deal represents a modernization of our relationship. Why did he say that? Because it included Charter Spectrum Essentials. It included our streaming products, both free, Pluto, and pay Paramount Plus. It's evolving with the times. It also includes an advanced ad partnership where we get data that allows us to target our linear spots in their ecosystem, So that's what you got to be doing, working with partners to together move it forward, unlock the broadband opportunity and elongate the TV media, the traditional side. That's what we're focused on. We're happy with the progress we're making, and we think that clearly differentiates us in the marketplace.
I agree. Content is king. And to that point, what is your content outlook? If we don't get an end to the Hollywood strike, that has also been a very big topic of conversation here at this conference. What does it mean to summer 2024 in terms of the box office? And then do we even see an end in sight to the strike?
We are saddened that we couldn't come to a resolution with SAG and the writers to avert this situation. Obviously, we're now in a strike. Certainly attention's being placed, and we're hopeful that we can get to a resolution. But at the same time, we have a responsibility to our consumers, people like you, and to our distributors and advertisers to continue to engage people with great content. You see that in the alternate CBS slate we've mounted, where we're pulling product from international, like the UK version of Ghost. We're pulling product from streaming, like SEAL Team, which used to be a CBS show, went to Paramount Plus, now is going back to CBS, like Yellowstone, which we were talking about before we went on air, which will run from episode 1 coming out of 60 Minutes in a double. Think about it, NFL into 60 Minutes into Yellowstone, that's killer night. And we're doing longer versions of some reality shows like Survivor and Amazing Race, 90-minute versions instead of 60-minute versions. So we're pulling all these levers to keep people entertained and keep our entertainment content compelling. And we'll just have to see how long this duration of strike goes and how that, yes, affects 24 and films in 24. And the good news, we have a number of films in the can, so we're good for a while. But over time, we'll have to see how to navigate it.
Before I let you go, one analyst here told me, the Paramount stock is at lows. We want to see the company reduce debt. Where are you at on reducing that debt? And is that a big priority or a big focus for you next year?
So go back to 2023 as peak streaming investment year. 2024 streaming earnings losses reduced significantly, which in turn drives growth in total company earnings. That is the most significant on a multi-year basis de-leverer of the company. But add to that what we've done with respect to non-core asset divestitures, things like Simon & Schuster. That is additive to our, call it, leverage ratio as we close it. So yeah, we will absolutely de-lever this company on a multi-year basis. We said 2 years ago this was our peak investment year. We knew that would increase leverage, but it's part of a cycle. And the good news is our investments are paying off. We are very much creating a scale streaming business that is, and you saw it in the second quarter, our losses in streaming were lower in the second quarter than the comp quarter. So we're on the right trajectory here. It will create material value. It will grow earnings. It will de-lever the company. And we're just focused on executing as we do so.
All right, we'll leave it there. Bob Bakish, President and CEO of Paramount. Thanks for always making time for Yahoo Finance. We appreciate it. I know these are very busy times. Thank you.
Well, we appreciate it too. Thanks, and we'll talk to you soon.
Thank you. Rochelle, back over to you.
All right, a big thank you there to our very own Brian Soziol, his hard work out there in San Francisco. Well, the hype around artificial intelligence hit a peak this year more than ever before. With that in mind, barring any doomsday iRobot references, the narrative has been relatively positive. Except for perhaps in one area of business that's seeing a wave of backlash, the entertainment and music industries. Now, the music industry has seen a number of releases with artists that didn't actually work together, like the viral collaboration between Drake and The Weeknd. Our next guest thinks artists might be able to help with the regulation of AI. Let's bring in music producer and author of Music at the Speed of AI, Jason Edmonds. We're also joined by our very own Jennifer Schonberger. A big welcome to you both here. Thank you for joining us this morning, Jason. Obviously, as we think about AI, and you're very welcome, and just how quickly things are evolving. For musicians, we've gone beyond traditional record labels to like self-launching on social media. What does AI now open up for musicians and producers and industry professionals?
Oh, it opens up tons of possibilities. I mean, you know, the idea that the pathway to success has been, you know, paved with a lot of the traditional methods, now all go away. Nothing is traditional anymore. Everything is experiential. So, you know, it opens the door for faster output in your production. It opens the door for a further conversation into how you market and how you advertise the music once it's done and once you're ready to put it out. And ultimately how you support it over time, which is the real ticket to success here in the music business.
Jason, Jennifer here. It's great to see you.
Hey.
How do you see AI being used for specifically music releases, and how can artists really leverage this technology?
Yeah, they can leverage it in a number of different ways. Obviously, for the monetization side of things, running ads and setting up a good funnel output channel is really the key aspect to getting your music heard to audiences that have never heard you before. And for new artists, that's paramount. So as you're releasing your new music, you need to run a specific ad program that engages your followers that you do have. It grows your audience out from there, and it introduces you to new audiences that otherwise would have never heard your music in the first place. And AI is a very good way of doing that because it can, you know, like chat can spit out specific plans that you can follow and alter and change according to your genre if you're not specific enough with chat about where your audience is, who you are, where your music is from, and thus. So, you know, it's just, AI is one of those things you just have to kind of dive in and see what you find. And thus far, I've been finding some really valuable information.
And Jason, of course, on the flip side of that, you've seen this backlash for, you know, a lot of artists who didn't put their music out there, but you have all these AI developed songs using their voices, mixing it with other things. As someone who's been on both ends of it, as a singer, as a producer, and then someone who's also sort of, you know, promoting use of AI in the industry, how do you protect yourself and really try not to step on any toes while still preserving, you know, your artistic creations?
Very good question. That is the question. How do you protect yourself? And, you know, obviously the music industry has its traditional ways of copywriting and securing the rights of the owners of the projects. And I don't know that AI really helps in that regard. Actually, it might even hurt in certain regards because, you know, there are certain AI, you know, engines that are written to copyright certain sets of melodies. Copyright certain, you know, well, you can't exactly copyright chord progressions, but you can do a number of things that kind of, for the creators, kind of adds a little bit of angst because we essentially come up with every component of music ourselves. So when you're adding a machine aspect to it, it kind of not dulls it down a little bit, but makes it difficult for creators to really be their true self in the music because you're now infusing something into it that has essentially made it easier, or, you know, for the public, you know, who knows? But I think that for the creators, there's a little bit of a learning curve and a little bit of angst as regards to copyright.
Jason, you have been an early embracer of AI, but there are a lot of people who are very scared of it in this industry. I mean, how do you see it impacting jobs, like for songwriters? And what is it that scares you most about AI?
Back on the subject of copyright, the thing that scares me most is the fact that you can essentially get AI to analyze a set of melodies. There's a company now that's going out and trying to copyright bulk sets of melodies that essentially would make plagiarism and conversations like that go away, but at the same time, rights ownership over the creation of a melody is a very big component to the music business. That I know some writers who are very successful at writing great melodies. And so when you take something like AI and copyright a set of melodies that essentially would cover all melodies, because that's what AI can do, it does add a little bit of anxiety there and a little bit of worry. But I think overall, the thing that will happen is the same thing that happens every time there's a new digital age in this business, back to the Napster days and even further back as when CDs took over. The human aspect will take over. And as long as producers remain open-minded and writers remain open-minded, there are ways that you can use AI to enhance what you already do. And it will definitely take a real songwriter and a real producer to make hit records. I don't believe that AI is fully capable yet of producing a hit song by itself without any human interaction whatsoever. And that's the good news for us.
Indeed. I mean, you come from an incredibly talented musical family. There are some things that, at least for now, the AI just can't always capture that magic the same way. We do appreciate you joining us this morning. Jason Edmonds, music producer and author of Music at the Speed of AI, Urgent Strategies for a Successful Release, and our very own Jennifer Schonberger. Big thank you to you both. Well, Disney and Comcast back and forth on the ownership of Hulu will come to a close this month. At Goldman Sachs Communacopia and Technology Conference, Comcast CEO Brian Roberts said his company and Disney have signed a modification to their deal, bringing forward the target date to come to an agreement on Hulu to September 30th. Now, the media exec added that upon that date, quote, Disney can call, we can put, and I believe that's what will happen. All right, well, that does it for now. I'm Rochelle Akufa. I'll be back with you on Yahoo Finance tomorrow. I'll see you then.